Good morning, Apelicio.
Good morning.
How are you doing?
I'm good. And you?
Badhiya? Oh, wow. Great, great. You're learning Hindi. Nice.
Yeah.
That's
Yeah.
nice. Someday we'll also try to learn your language. अगर ठीक है.
Yeah. Hmm?
Good morning, Mr. Tan. Good morning, Jose. Jose, I can see.
Good morning, team.
Morning. How are you, Jose?
No, I'm pretty good.
Okay, great. Good morning, Mamta.
Good morning. How are you?
Mamta, you look very pretty serious.
No. I was working on the other things and then I saw the time over.
Okay.
So-
Okay. Now your video is very clear. Great. I know I'm still pronouncing it wrong, but it is still 2 more weeks for this course to end. So by the end of the course, that is my target, to pronounce it correctly. Okay. So I have 2 more weeks to learn.
But the name?
Yeah, the names to spell it correctly.
Yeah. Apelicio. Yeah.
Good morning, Dr. Punita.
Hi Divya, how are you?
I'm good. How are you?
I'm good. Very good morning to all the participants.
A very good morning, ma'am.
Do you all like sari? I have this question. Do you like sari?
Yeah.
Yeah. What
But
about
not-
others? Do you like sari?
So I think most of our participants don't know about the sari. I think from the Tanzania and Peru and
Yeah. Maybe most are. So I'm asking this because last time when we had this program offline,
okay.
so they came to India, basically they visited the campus. So while returning, almost every one of them were carrying 50 kgs of luggage. They
Oh,
bought so much of clothes, shoes, and all the shopping that I was feeling at one point they are more Indian than us. So
Okay.
yes.
Divya, have Anjali joined?
Yeah, Dr.
yeah,
Anjali,
Dr. Anjali is there. I think.
can you put your video on? I'm not able to see you, but I think she's trying to fix Dr. Punita, so you may introduce.
Okay.
Just a second. I think she's rejoining. Just a second. Good morning, Noah. Good morning, Tida.
Hello, good morning everyone. Happy to see you today.
That's nice. That's so much of energy.
Okay.
Good. So Divya, shall we start?
Just a second. I'm checking with her. Once she joins, we can start.
Okay. No question. I hope all of you are having good time and probably you are getting good knowledge about the different aspects of marketing. You had day one, week one, and then HR. Am I audible, Divya?
Yeah. You're audible.
Okay, good.
Yeah. So you are saying that we. Okay. Dr. Anjali is joining. You're right. So we begin with strategy. Then we covered marketing. We also covered HR, and today we are starting with fourth.
Yeah.
Items. Dr. Anjali, it's there. She's there. Good morning, Sebastian. Where is she, Anjali? Dr. Anjali, are you able to unmute yourself?
Good morning, everyone.
Good morning. We are still not able to see your.
I'm trying to fix the video. Just a second.
Sure, no issues. Dr. Punita, you may clear. Yeah, we can see you.
I hope
Okay.
it's visible now.
Yeah.
Yeah, it's visible. Fine. Okay, a very good morning once again. A very good morning to all of you. And I hope in all your countries, you're all having a good morning time. And so today is the day 12 for the workshop. And we are going to start with the next module that is for accounting and finance. And in this particular module, you shall be covering about the basic terms of accounting and understanding the different financial statements, which includes understanding profit loss account and balance sheet. And this part will be taken up by Dr. Anjali Sharma, who is our guest for this session. And then the next second half of today, we shall be covering the cost concepts and the cost concept for financial decision making. So we shall be using and trying to understand how the different cost is analyzed and how that is being used in the decision making and for the budgetary analysis. That part will be taken care by me only in the second half today. And then tomorrow we have got another session by Dr. Seema Gupta. She will be taking care of financial statement analysis by using the financial ratios and the market valuation ratios, something which is very important to understand from business perspective. And we shall also be understanding how to read the cash flow statements. These days, every company will present you the cash flow statement. So we will understand how to read and how to understand those cash flow statements. And then what are the different other techniques of financial statement analysis. So that we shall be covering tomorrow, that is day 13. And on day 14, the first half of day 14, we shall be doing the final aspect of financial analysis, that is capital budgeting decision, which is very important for any business to understand and to judge whether which projects they should undertake or which projects they should not undertake. So that capital budgeting decisions will be taken care by Dr. Seema Gupta in the day 14, the first half. So this is what we are going to do in this accounts and financing this thing. And so today we have got Anjali Sharma with us, Dr. Anjali Sharma. She will be taking care of the basic accounting terms and understanding the financial statements. So once again, Dr. Anjali, welcome to Amity University and to this particular workshop. And we have got Dr. Anjali is currently working as assistant professor at Mittal School of Business and Lovely Professional University, Punjab. She's actually involved in the content development and delivery of online learning for working professionals. And under a project, she's working with UGC with Lovely Professional University. And she has all successfully conducted 5 workshops and delivered different guest lectures at Amity University and other places. And she is also a very indigenous researcher and presented several research papers at national and international level. And she has got, she has written 5 research papers in the different edited journals. And once again, Dr. Anjali, you are most welcome. And now this session belongs to you. Over to you, Dr. Anjali.
Thank you so much, Punita ma'am. A warm welcome to all the participants. So here we are going to start with our session regarding the basics of accounting. So before I start, I want the participants to interact with me. So what according to you is accounting? Can I have some answers in the public chat? Any idea, any clue you have regarding what is accounting?
I think accounting is a process which deals with collecting money and making some some budget to cover the all things that the organizations need to be there in order to work. And the final to analyze how the money was used. In my understanding, I think my colleague has a good understanding about it.
That's really great. Thank you for actively participating. So anybody else from the participants who would like to add on regarding what is accounting?
About so bookkeeping and the recording of your financial transaction going on your organization. It gives the input for your financial statement.
Yes, that's right. How about others? Okay, I've got some people explaining in the chat.
Yeah,
Okay.
I wrote there, and then again
Okay.
I talked to you.
All right, all right. Okay. So anyone else who would like to add on to the discussion before I start? Okay, let's start from basic, okay? Suppose you want to conduct a party and you have a limited budget. Okay, so you have limited money, maybe, you know, let's go back to our childhood days. So your mom, dad would give you some pocket money and they would say, okay, fine, you want to have some fun. Then you have to, you know, make your expenses out of that money. So suppose, I'm just explaining it in the chat. Suppose you are given $50. With due respect to the international participants, I'm just taking one example. Suppose you are given $50 and then you have to conduct party, you need party poppers, you need some eatables. And suppose you are spending around, let's say, $65. And now you are already gone out of budget. So you go to your parents and you say, you know, give me some more. Okay, so when you're asking for $15, don't you think your parents would be asking you where you spent? Yes or no? That's quite obvious. They're going to ask you.
They're going to ask with us.
Yes, they are going to ask you. So you are basically giving them a fine idea regarding your expenses. So you had your cold drinks, you had your burger, you had some decoration, okay, party poppers, then balloons, whatever you needed to decorate the room. Now, this is accounting. It's part and parcel of your daily life. It's not just, you know, restricted to a business. Every single individual, you have limited income and you have to carry out your expenses within that amount. So even a common man is doing accounting. Now I'm coming to the business perspective when we are asking about accounting. See, accounting is basically a language of business with which you are communicating the financial performance, position of your enterprise to the interested parties. Okay, so when we are saying to the interested parties, who could be the parties? Tell me. Yes. Who could be the interested parties in your accounting information? Anybody?
Investors.
Yes, very good. Investors. So it's investors, it's the banks which are going to grant you loan. Then it could be your that we say as non-banking financial institutions, money lenders, creditors who are interested into knowing your financial performance. Somebody comes and says, I need credit. Blindly, you will give credit. Or you will look into the profile of the person. Is he financially sound? having some property in backend, so that in future, if my money is not getting recovered, at least I can sell off his property and get my money back? Yes. So when in simple terms, when I'm saying accounting, it is the process of recording, classifying, analyzing, and interpreting the business transactions. Divya ma'am, are you there? Divya ma'am, are you there?
Yeah, Anjali, any issues?
I just wanted to know, is the PPT visible to the participants?
No, not
No.
visible, not visible.
Okay. Can you do
You
that?
you can share from,
Yeah,
you can
just-
do the share screen.
Yeah, sure.
Now try sharing the screen. You will be able to. You try.
I'm trying to. So. Yeah, I think now it's visible to all.
Yeah.
Okay. So accounting is the process of recording, classifying, analyzing, and interpreting the business transactions that is measurable in monetary terms. So can you identify some important adjectives that are used here? Can you suggest some of the objectives that are used here in the phrase? They are already in bold.
Yeah, it's recording, classifying, analyzing, and interpreting.
Yes. So we are recording. So I gave you a basic example of your childhood days when you were holding a party and your parents are asking you about your expenses. So you will jot down, okay, I got, eatables for, $10. Then I got some candies, some cold drinks for $5. So you are having a complete access of information where you have spent the, so you are recording. Now, if I'm talking about a common man, you will just have a piece of page and you would be jotting down your expenses. But from business perspective, we have dedicated books of accounts. We have a journal, we have ledger, trial balance. Then you have trading and profit and loss account, balance sheet to record the business transactions. Okay. And when I'm saying classifying, can you explain me how do we classify the accounting information?
As you gave the example of childhood, and then you are just classify your expenses. Okay, we'll just in drink, we'll going to we just spend this much amount, and then other stuff like the playing items and then decorating items. So as per their, the nature, we can classify the expenses.
Exactly. See, when we are talking about, recording, classifying, first, it is important to understand when I'm saying classifying, you have different sets of, business transactions. Some are related to, you can say, purchase of fixed assets. Some could be related to procuring your raw material. So you are basically categorizing your business transactions. Some of the purchases are on credit basis. Some are in cash form. So how would I come to know by the end of the financial year how much money my business has to pay to the outsiders? That is why you have to classify the accounting information, that by the end of the financial year, you are clear how much amount of debtors I have, how much amount of creditors I have. So classification is concerned with classifying the recorded transaction so that you have a group of transactions under one head, like debtors. So Sebastian is there in my class. Okay, then let me just take the name of few students. So Jose is there, Thida is there. Okay, so with due respect to everybody's name, if I mispronunciate someone's name, please do apology for the same. So you might be the people from whom I have purchased goods on credit, or you people could be the one to whom I have sold the goods on credit. So group of transactions, debtors, creditors will be there. Now, who are debtors? Can you tell me who are debtors?
Sorry, who are what?
Who are debtors?
The ones I own money. People, the organization or organizations, the company owns money.
Okay, debtors are the ones who have to pay money to us. I have sold goods on credit to somebody.
Okay.
Okay, so credit transaction is there maybe after 30 days, after 3 months, depending upon what is the term and condition of contract between me and the buyer who has bought goods on credit from me. They are my debtors. Okay, similarly, if I have purchased goods on credit from somebody, I am to look into how much amount of money I pay to the outsiders. Okay, so maybe I have purchased goods from David, from John, from Jacob. So they all are the creditors. They have allowed me to purchase goods on credit. So with accounting, I come to know that how much, I have to pay to outsiders, I have to receive from the outsiders. So this function is basically performed by maintaining ledger. When I'm saying classification, here I'm specifically talking about ledger, which is a T-shape account for jotting down the total amount of debtors, total amount of creditors, total amount of fixed assets purchased during the year, how I purchased, that was by bank, by cash. So all those detailed information is classifying your business transaction. I'll give you a simple example. Suppose you have the goods on credit. Okay. If you have purchased goods on credit, then you have to maintain a purchase account ledger, so that you come to know on which date you have purchased the goods on credit. Then after how many days, how many months you are paying back the credit to the creditor. So that detail is being maintained with the help of classification of business transactions. Okay. Then let me come back to the slide. We are in a way maintaining a permanent record of business transactions. Fine. So every financial year that we are doing business, we are maintaining the complete record of business transactions. I'm giving a simple example in this context. Just a second. So I'll be giving you a live example. And I'll be sharing my screen with you as well. So here is the Nestle India. It's a multinational company which is doing business in India. So here you can see Nestle India is maintaining its books of accounts, its profit and loss account year after year. Since its incorporation in India, I can see that the company is maintaining its profit and loss account. So every year, and we are basically here referring to going concern concept. Nestle India has in its mind that for indefinite long period of time, it will be conducting the business. And if it is going to do the business, it is obligatory, it is mandatory to maintain the profit and loss account and balance sheet. Okay, so this was the standalone profit and loss account of Nestle India, as you can see. I hope it is visible on your screen, everyone.
It's visible. It's visible.
Okay, thank you. So this is the standalone, and when I'm talking about the balance sheet, this is the balance sheet which is giving you a fair idea regarding the assets and liabilities of the company. Just a second. So here we have balance sheet. Equities and liabilities, shareholder fund, And here you can see 5 years data is there. Even you can go back date and you can get the balance sheet information of Nestle India. There are two tabs here on the screen, standalone and consolidate. Can you tell me what is the difference between standalone and consolidate? It's just basic, discussion. Okay, let me help you. When I'm talking about only specifically about Nestle India and what is its business in India, that is standalone. When I'm talking about Nestle India, when I'm talking about Nestle as a group, including all its subsidiaries, so when I'm talking about the total business, total turnover, total sales, total profit of Nestle India all over the world, that is consolidated balance sheet. This is just a basic information that I'm sharing with you. Now coming back to the PPT. Is the PPT visible now?
No,
Mamta, it's not visible?
not visible. It's visible. Still, it's national.
I'll share it again.
Yeah.
I hope now it's visible.
Yeah, it's visible now.
So this was the perfect example of understanding how in accounting there is a permanent record of business transactions. Now, so what is the moral of the story regarding accounting? That it's an art of recording, classifying and summarizing in a significant manner and in terms of money, transactions and events, which is having the financial character. And you will be able to interpret the results thereof. So I'm dividing this whole explanation into small parts. We just discussed about recording, classifying, summarizing, okay, in a significant manner. Now, which is that manner? You have got your profit and loss account and the balance sheet, which is prepared at the end of a financial year. So for whole year you did business, and side by side in chronological order, in the order of date, you were recording the business transactions. And thereafter, you are summarizing your business results in the form of financial statements, that is trading and profit and loss account and balance sheet of your company. Mind it, only business transactions are to be recorded. So here I want to know what is meant by business transaction. What do you think is a business transaction? You can type your answers in the public chat. Who can explain me apart from Mamta? Thanks so much for actively participating, but I want everyone to answer.
Yeah, that's why I'm not going to answer your question now. That's why I'm keeping
I'm
silent.
waiting for others also to
Yeah,
answer.
thank you, Dr. Anjali.
Noah, could you answer?
Okay, I think business transaction is the cash flow which we have as a result of our sellings, the sale of our service. So what we receive and what we pay to have the service and what we get as from the customer as the result of sell the service. I think so.
Okay. That's great. At least you have answered a little. Thank you. What about others? What about the others? I want active participation. Yes?
Yes, I think the exchange of goods and service or money between customers and a company or organization.
See, when I'm saying business transaction, there is a benefit which each party is receiving, and we have a common thing, that is, sharing, or I would say exchange of monetary value. So either, for example, got a Bisleri bottle, if it's visible to you all. Yeah, I've got this bottle. I was feeling thirsty when I was coming for the class. So this is Kinley's bottle. So I went to the shop, I gave him money, and I got this bottle. Okay, so this is a business transaction. For a seller, 1 unit of Bisleri bottle is sold. And for me, I have received the benefit. I'm using this bottle for quenching my thirst. So this is, I am also receiving something in return for something. Now that something is money. The seller is getting money. The buyer is paying him the money to get a bottle of Bisleri. Clear, everyone? So what we do is we need to identify the economic, you can say, transaction. Okay, you need to identify economic event. Okay, and once you have identified the economic event, you know how you're going to measure that economic event. So you people are from all over the world sitting here, and we are in this workshop together. So in your country, you have your own currency. Someone is having dollars, someone is having yen, someone is having peso. In India, we have INR, that is rupee. So every country has own currency. So when you are expressing any business transaction in a common currency form, that's how you are recording the business transactions. Okay. So recording is basically you are recording the transactions in a chronological order, daily basis. So if I'm running a confectionery shop, daily basis, the clients are coming, they're checking in, they are purchasing candies, whatever they want. So and they are paying me money, maybe through credit card, through debit card, maybe cash. So I am recording my business on daily basis, and I'm using softwares, a computerized system, and I'm fetching the data of what all units I have sold, what is the value of each item, grocery item that I have sold. And by the end of the day, I have a complete stock, how much units I have sold, what is the total sale of the day, week, months, yearly basis. Okay. Clear, everyone? So just have a quick look. Once economic events are identified and measured in financial terms, they are recorded in books of accounts in monetary terms and chronological order. Order of date. Then we have talked about the classification, how you are classifying. So I gave you example of debtors, creditors, items purchased, raw material purchased, fixed assets purchased, bank transactions, separate account is maintained. so that in totality, I know how much I am to receive, I have to pay, where the money got spent, and so on. Fine. So as of now, this is half work done. Recording, classifying, summarizing is half work done. The major concern is this: interpretation. Interpreting the results thereof. So when I'm saying interpreting, it is basically you're interpreting the financial statements. What is the profit and loss account of your company stating? What is the balance sheet of your company stating? What is the financial performance of your company during the given financial year? Last year, past 5 years, 10 years, comparing yourself with your competitors. I'm giving you 5 minutes. If you have any doubt in this discussion, please ask me. In the public chat, you can let me know your doubts. Victor, I cannot see you. If we have Victor, I cannot see you, Victor. You have asked me in the public chat. I just saw you. I cannot see you, Victor. I'm giving 5 minutes so that in case anyone is having any doubt, he or she can ask. Your queries are most welcome. Shall we proceed then? Okay, so buying insurance from insurer. Victor, in which context are you asking? Could you please elaborate? You have typed buying insurance from an insurer. Yes, from if it's an insurance company, you are selling the insurance, that can be considered as a business transaction. Okay. There can be different types of entities that can be formulated. Okay, so that way, yes, it can be. So let us summarize. Accounting is basically an information system, okay, in which you are identifying, measuring, and communicating the economic information regarding your business organization to the concerned people. So that can be government of your country, it could be income tax authorities, it could be banks, creditors, debtors regarding your business. Okay. Now, when I'm saying interpreting, see, you have recorded, you have just got the numbers, the figures, the fractions. But what does those fractions, those figures are trying to speak? So you are trying to understand the nervous system of the figures. So the figures, whatever figures regarding the business are in front of you, you are trying to find out the meaning and significance of each and every item which is part of your profit and loss account, balance sheet, on the financial performance, on the business performance of your entity. Okay, so like for example, in accounting, we are trying to understand what has happened. Okay, why it happened, and what is the possibility that it may repeat or it may happen again in the future. This is interpretation. Anybody now having any doubt, you can ask, otherwise I'll proceed further. So we talked about just a second. Here we talked about what is accounting. Now we are saying accounting helps in knowing the true financial position of business. So I'm going to share an example with you. It's a case study that I have written. A recent case study I have submitted in one of the, with one of the publisher. Let me just share it with you. It's opening. You can do this, even in your country. So I'm going to share my screen with you all for this. Let me share the document. So this is a case study which I have recently written. Just a second. Yeah. So this is a case study that I have written regarding the impact of COVID on business of Bollywood production houses. So every country would be having entertainment industry. So I tried to look into the competitors. So here, if you can see, this is a data which I have taken, profit and loss account of competitors. So here in India, we have a production house called Balaji Telefilms. Then we have Eros International Media over here, UFO Movies India, and Shimaru Entertainment. So I've taken 4 competitors, and with this, I am able to draw a comparison between them. So profit and loss of before the pandemic, during pandemic, and revival from pandemic, 4 years data I have taken over here, and I tried to understand which particular production house has performed well in comparison to the others. So the top performers or the top production houses in terms of profitability for my study I have taken. I hope it's visible to you all. So this is Balaji Telefilms over here in India. So I have drawn a comparison. This is interpretation. When I'm comparing my business with others in the same industry, I can take pharmaceutical industry. So there would be a lot of, pharma based companies in your countries. You can compare their performance, one specific company, and you can compare its competitors vis-a-vis how they have performed. So you are interpreting the financial results, you are comparing, and you are strategizing how you can improve your operations, your efficiency in the future. This is the part of accounting, interpretation. Merely preparing the financial statements is not doing the work. What is doing the work is your interpretation, whether you can understand the financial health of your business properly or not. Shall we proceed? Yes? Okay. Another thing is, accounting is providing valid information to the owners, to the customers, government, and outside parties, so that corrective actions can be taken for the future. Like, for example, pandemic. The world economy was affected due to pandemic. We all know, we all have experienced the repercussions of pandemic, where we felt that our liquidity, our finances are squeezing and we are out of money. People were either out of job or they had less, spending because they had very limited income left in hand. Very difficult time. We all have experienced it. But what it is telling me, I can compare how much money I was able to spend before pandemic, during pandemic, and now when the things are getting normalized. This is applicable to business also. Why your profitability shrinked during pandemic? Obviously, when it is curfew, when there is shortage of raw material, there is no production going on. So how can you sell your product? And moreover, even if you're making the product, do you have actual buyers? A big question mark. The biggest example, latest example is of Pakistan. Example is of Sri Lanka. So much inflation is there. Their economy is crashing. The whole world knows about it. And the basic necessities have become so damn expensive. Medicines expensive, food items, grocery items are very expensive, and vegetables. Latest news was regarding UK a few days back. UK, Pakistan, they are facing so much of difficulty with respect to vegetable supply that they are asking their citizens to use 2 pieces of tomatoes. UK is saying because there is a lot of difficulty in procuring vegetables from the international market. So this is accounting telling you earlier you could spend more. Now your finances have crunched and you need to improve for the future. How are you going to manage the crisis? It's not just you as an individual, it is also for the business entities. Okay, now moving on to the types of accounting. So anybody having any idea regarding types of accounting before I start? What are the types of accounting? I'm going to share my PPT also, but I want you people to discuss. Yes. We will be talking about the key differences. Need not to worry about it. So I'm sharing the PPT once again with you all. These are the 4 major types of accounting: financial accounting, cost accounting, management accounting, and corporate accounting. So before I start this, if you have any doubt regarding the basic meaning of accounting, please let me know. I will be waiting for your pop-up messages in public chat, else I will proceed accordingly. So, okay, fine. Let's start one by one regarding what is, cost accounting, what is financial accounting, then what is the management accounting, and what is the corporate accounting. Okay, one by one, we are going to discuss them. So without much ado, let's start. When I'm saying financial accounting, whatever we discussed about what is accounting is that only. So identifying, measuring, recording, classifying, summarizing, analyzing, interpreting, and communicating the financial transactions is known as the financial accounting. Okay, so here I'm mentioning financial accounting is all about identifying, ascertaining, or you can say, just a second, identifying, measuring, hold on, I'm just writing. Identify, measuring, recording, classifying, summarizing, analyzing, interpreting the financial information. So have a quick go through. This is all about financial accounting. So when you are recording the financial transactions, which is obviously not in qualitative form, rather it is in quantitative form. Like I said, dollar, yen, Indian rupee we have, okay, taka. So you are using different currencies to record the business transactions. That is your financial accounting. And when I'm saying, it is cost accounting, it's all about ascertaining the cost of production of a product. What will be the cost of production? So how much raw material you need, how much labor you will require, what will be the cost of producing a product, fine? What should be the selling price of your product, how you have to control your expenses. This is all about cost accounting. So it is the practice of a business in which you are recording, examining, summarizing, and studying the cost of a product which you have spent on producing. Okay, you have spent on producing a product. And depending upon that only, you have to decide what will be the selling cost. Now, I'll give you an example. Now, suppose to make 1 glass of juice, it requires 1 apple, 1 piece of pineapple, depending upon what juice you want, 1 slice of mango. In total, whatever amount of fruits you are adding for 1 glass, it's on an average 10 rupees fruit pulp you're adding. Then you have lemon juice. You have sugar or salt to add, then some ice. Okay. So in total, 1 glass is costing you, suppose, rupees 35 per glass. And I want profit also. So for earning profit, I am setting the selling price as rupees 50. So what is my profit margin? What is the amount of profit? Come on. 15 rupees. That's right. So I have done cost accounting. I have used labor. Okay. I have used power, electricity. I have used fruit pulp. So all these are my expenses. And after that, I decided my selling price. Okay. Clear, everyone? So I'll give you a simple example in this context. Just a second. Please confirm if my screen is visible to you all, and in case, just a second. Okay, just hold on. Is Divya ma'am there? Divya ma'am? Divya ma'am, I'm sharing a small video link with you. It would be great help if you could play it, because
Sure.
I'm not able to play it. Just a second.
Yeah. Share the link on a chat so that I can.
Yeah, ma'am. I'm doing. Ma'am, see if it can work.
I have. So you have WhatsApp. Send it on a Zoom chat.
Okay.
Okay.
Just a second.
It will be.
Yeah.
Professor.
Okay. Mohammed has said he has not understood the example. Mohammed, we will be doing this example once again. Just a moment. It's taking a little longer. The example which I am sharing through Divya ma'am with you all, it will be explaining what I was just trying to explain. So please go through the video. Divya ma'am, I've shared the link with you.
I haven't received it.
Ma'am, check it in the public chat.
I already did. Okay, wait, let me see if we can send it from.
So cost accounting is helping me to decide whether I should make a product in my premises or I should buy it from outside. This specific video is explaining a very simple example of making a donut. So if you're making a donut, one piece of donut is costing you how much? So you are estimating that. Depending upon that, In future, you will decide the selling price.
I'm able to.
Okay.
I'll share.
Service is part of nearly every customer experience we have.
Is this right video? I hope.
Yes, it is. If you could slow the speed, it will be great. Settings, mein there is a click. If you click on setting, there is you can minimize the speed. So you can make it 0.75. It will be easy for them to see.
Yes, done.
created using Powtoon.
Thank you, Divya ma'am. I'm coming to Mohammed, your query. You were asking me regarding the example. So here we saw, yeah, I hope I'm audible to you, Mohammed.
Yes. It's clear.
Right.
It's clear.
So
Good
here
morning.
we just saw, yeah, here we just saw an example. I'm thinking of to start a business. So I'm thinking of that I will be doing a business of donuts. So in my shop, I will be selling donuts. Now I have a choice. Either I am procuring ready-made donuts from someone and I'm selling it in my shop, or I would be manufacturing donuts in my shop and then I would be selling. So I'm making a comparison. If my own cost of making a piece of donut is, let's say, over here, 0.50 per piece. Okay. But if I'm going to purchase, it's going to cost me whatever is the currency over here, let's say 1 per piece. So I am in a way saving 0.50 per piece. Yes or no? Mohammed, can you? Yes. So I am basically saving 0.50 per piece. Now, I want profit also. Yes or no?
Yes.
Of course. And if I'm running a business, obviously I want to flourish and I want to make money. So what I'm doing is I'm going to set the selling price. My own cost of making a donut is 0.50 and I am charging, let's say, 3 rupees. RM 3. So what is my profit?
What is
How much
SP?
profit?
What is
It's
SP?
just
Professor.
yeah,
SP
it's just
equal
it will be 3 minus 0.5. So 2.5.
2.5. Yes.
Yes,
2.5.
per piece I'm going to make. Yes, this is what cost account is telling you. Identify your expenses. So you need flour, you need maple syrup, you want to have vanilla flavor. So all those things which you are adding, what is your own cost of making that? And then decide what price should you charge that you have ample amount of profit. You want flourish, you grow your business, you want to, maybe you start your business with a rented shop and then you want to have your own shop, you want your own building. So how would money come? From profits, where I'm able to cover my own cost of manufacturing and then I have buffer amount, I have surplus amount. So surplus amount is SP selling price. Yes, Victor, selling price. Absolutely right. So this is a simple example for cost accounting. You do that in your day-to-day life. You will see people doing that all around you. Even a vegetable vendor, a fruit vendor would be making profit. He is doing cost accounting. So right from if the fruit seller is himself growing fruits, then what is the cost of seeds? Then what all fertilizers, manure he has used for rearing the plants, for growing them, for their protection that they don't get eaten up by worms. And then plucking the, you can say, ripe fruit for selling it in the market, whatever cost, transport cost is involved, everything he has jotted down because he wants his own cost to be covered as well. This is cost accounting. I hope the meaning is clear to everybody. Clear, everyone? So let us proceed further then. If someone asks you, what information are you basically the cost accounting? You are recording the information related to material, purchase, overheads, all those expenses. Fine. So let us proceed further with our discussion. Coming to management accounting. Okay. Moving on to management accounting, where you are done with your financial and cost accounting, we start with management accounting. Mind it, financial and cost accounting, they are basically called as post-mortem accounting. Something that has already happened in your business and you have absolute no control over it.
Orange दिख रहा था
What already happened, so that is to be covered under your financial and cost accounting. But when I'm saying management accounting is forward looking, taking corrective actions from your past mistakes, your inefficiencies in the business is all that we do under management accounting. Taking decisions, making policies for correcting the problems in your business, your poor performance in the past, your losses you want to cover. Future decision is part of management accounting. Anybody having any doubt regarding what is management accounting? Mohammed, is it clear?
Yeah.
All right. Anybody else from the participants regarding the management accounting? If anyone is having doubt, you can ask me. So if in nutshell, I have to say what is management accounting, it can be defined as a process of preparing reports on your financial and non-financial transactions. In the financial accounting, we said we only consider the quantitative information. In cost accounting also, we are recording only quantitative information. How much amount of labor, how much raw material consumed. No one is talking about qualitative factors, reasons. So management accounting is giving focus to both financial and non-financial transactions so that corrective actions can be taken. Under the management accounting, like in the later half, you will be studying about the ratio. So we have ratios, we have the key performance indicators, key result areas, and financial modeling for improving the results of your business. This is what we are doing under the management accounting.
Okay, Anjali, can we take a break here?
Yes, sure, ma'am. We can take a break.
Okay, I think all of you can take a 5 minutes tea break and then we can start in another 5 minutes again. Divya?
Nazir, can you stop the playing in 5? Thank you. And make me co-host. Okay, Dr. Anjali is back. Participants, are you all back from the break? I think, hi, I see Mr. Khan. Yes. Mr. Khan, do you even go for a break? Do you get out for a break? I thought so. Everyone else, we need to start again. So let me know if you have joined. Mohammed says yes. Okay. Dr. Anjali, over to you. I think Jose is also there. So
When can I start?
yes, you're saying something.
When can I start?
Yeah, we are starting. We can start. Thank you.
Okay.
Let's start, Dr. Anjali.
So back after a short bio break, and let's start where we just left. So I'm just taking the part here. Yeah. So over to now discussing the nature of accounting.
Dr. Anjali, can you
Yeah.
put it on slideshow mode?
Yes,
can-
sure.
Yeah.
Is it visible to all?
Yeah.
Okay. So now we are going to talk about the nature of accounting. And here we are saying that accounting as a profession. Now, when we are saying accounting as a profession, see, a person who has a thorough knowledge regarding the accounting principles, accounting concepts and conventions is the person who can actually record the business transactions. Okay. And of course, that person will be developing skills to analyze, interpret the financial health of a business. So accounting as a profession is, just let me admit people, they are still entering the online class.
No issues. Dr. Anjali, I and IT host will do.
Okay, thank you, ma'am. So here we talked about accounting as a profession. Then we said accounting as a language. Now, let me tell you one thing. All over the world, when people are doing business, every country has got a certain set of accounting principles, rules, regulations. Okay. Now, when I'm saying accounting rules and regulations, we have IFRS, that is International Financial Reporting Standards, how business transactions should be recorded. So we have got a common language of recording the business transactions. So which item to be debited, which item to be credited. You are purchasing a fixed asset, you are purchasing a raw material. So what will be the nature of those items? There's a common language of recording the business transaction. So when we are over here in this room, we are people from diverse background. We are from different countries of the world, but we have one common language, that is IFRS. Now your country would have either converged or would be adopting the International Financial Reporting Standards. Like over here in India, we have IAS, Indian Accounting Standards, which are inspired from International Financial Reporting Standard. So any Indian company can do business globally, and you can compare the business of your company in another country with other competitors in the same industry. So if I'm starting a confectionery business in overseas, all those entities or companies which are already operating, let's say I want to do business in France. So many other companies in France will be dealing into confectionery business. I can compare my performance with those in France. And at the same time, I can inform my Indian, parent company, what is my business performance? So this is accounting as a language. When I said accounting is science and art, because with the end of this course, you will be understanding how to record, how to classify, analyze, interpret the business transactions. So you're learning the skills to record the business transactions, classify them, summarize them, analyze your business performance, and take corrective actions for the future. Now, when I said information system, can anybody throw some light on how accounting could be a powerhouse of information itself? Anybody who can tell me? Anyone? Can I see the public chat? Anyone who can tell me that, accounting could be a powerhouse of information? Anybody? Now, When I'm saying information system, you have actually maintained a proper database of your business transactions, okay? And there are end users internally as well as externally, okay? So when we are saying that, it's an accounting information system, all the stakeholders, the government of any country, income tax authorities, debtors, creditors, employers, employees, they all would be getting a fair idea regarding the assets, liabilities, the value of a business. And accordingly, the stakeholders will be getting their stakes met. So if I'm an employee, I want better hike in my current salary, in my wages. How would I come to know? If the company is not paying the adequate remuneration, how would I come to know? I'll simply open the profit and loss account of the company and I'll get an idea. What is the actual income of the company? What are the liabilities of the company? What is the net profit of the company? And why can't the company pay me better remuneration? As a bank, I can come to know what is the the financial health of a business. How much loan can be given to an entity? I can assess that on the basis of its business performance, its past record. Is it a financially sound company, or its profits are unstable? So those decisions can be taken. Ready information can be easily fetched from the profit and loss account and balance sheet of any entity. So I gave you example of Nestle India. You can open up its profit and loss account, its balance sheet, and can easily understand how it has performed. Clear, everyone? So next comes the process of accounting. So when I'm saying process of accounting, there are business transactions which we are going to record in chronological order, date-wise. And after that, we are going to have the ledger accounts prepared. Then after the ledger accounts are prepared, you are preparing the trial balance. Okay, you have your debit and credit balances, and from there you are making final accounts. That is to know what is the profit, what is the loss of the company for the given financial year. Okay, and after that you will have the balance sheet to know what are the assets, liabilities, capital of the company. I know you might find it a little difficult because you are yet to cover the accounting terminologies, which I'm going to very shortly discuss with you. So anybody having any problem in the process of accounting, please let me know. Shall I proceed further then? All right. So let's proceed further. First important terminology is asset. So assets are basically resources which are owned, controlled by a business enterprise. I'm giving you an example. Let's say I want to start a logistic business. So for a logistic business, I require some trucks, some handling equipments, maybe crane, operator. Okay. So there is an involvement of machines, tools, trucks. So when I'm starting a business with all those, important necessities, they are termed as asset. These are the resources owned and controlled by the business enterprise. So land, machinery, furniture. Okay, then we have, if you can see here, cash and bank balance, stock, investment, etc. These are the assets. Further, they can be classified as fixed asset, current asset, the investments. So fixed assets are, for example, the building of your business, the office where you have started it up. So they are the fixed assets, machines, land and building, plant and machinery. We actually use a term called PPE, that is plant, property and equipment, as per IFRS. So all these are the fixed assets. Now, fixed assets are the ones which involve a capital expenditure. That means you have spent money at one point of time to purchase those assets. So for example, on 1st April 2023, you are purchasing certain, you can say machineries, some land and building. Now, the money you have spent, its benefit you are going to get in near future. So machine will be having, you can say, useful life of 5 years. So maybe the trucks you have purchased, loading, unloading equipments you have purchased, investment you have made in them is of 4 crores or 4 crores. So once you have spent, they are in a way helping you to conduct your business smoothly. So for coming 5 years, 10 years, this machinery is going to help you earn business income. Fine. Furniture you have purchased for your business. So investment you have made in the furniture. So it's you are expecting that it will be in a maintainable condition for coming 5 years or 10 years. And as you know, plastic chairs and all those office you can say furniture that we have, they don't go that long, right? So they have a specific useful life. Those are termed as fixed assets. Then we have current assets. Now, current assets are the ones which are already in the form of cash or cash equivalent. That means anytime you can go to the market and sell it off to get money. Let's take an example. My business is to manufacture air conditioners, refrigerators, television, sets. So the moment I'm going to sell any piece of such, product which I'm manufacturing, I'm getting cash. Yes or no? So that is termed as current asset. Or I have cash in hand, cash currency notes, or my money is in the bank. Anytime I'll go to the bank, withdraw the money and get the payment done. Then we have investment. You have made investment for 1 year, okay, for 6 months. So that is your investment, fine. Then fixed assets, as I said, they are purchased for a long period of time, more than 1 year. This is actually, you have purchased them at one moment of time, but its benefit you are going to get for more than 1 year. Fine. So these assets form the basic infrastructure of the company and which are not held for sale. Then we have current assets. So stock of air conditioner, refrigerator, washing machines that are manufactured in my premises. So that is the inventory, which we also call it as stock. Cash in hand, bank balance, debtors, those who owe money to me. So I have sold air conditioner to, let's say, my business partner for 6 months credit. So after 6 months, whenever the 6th month, as per the date is ending, I will be recovering my money. That is debtor. Or receivable, they have to pay money to me. Then is investment. If you have surplus funds, you are purchasing the shares, the bonds of government. This is an investment. And this is going to give you or generate income in the form of interest and dividend. So it will generate gain or loss when you're going to sell it. The next terminology is liability. So liability is basically the business obligations that you have to pay. So it can be owner's capital, borrowing, creditors, and payables. When I'm saying it is, owner's capital, when you're starting the business with some money. So whatever money the owner has invested into the business, that is owner's capital. You have taken long-term loan in the form of debentures or maybe bank loans you have taken, that is your borrowing. And creditors, when you have purchased goods on credit, those people to whom you owe money or your business owes money, they are creditors or payables. Then we have long-term liabilities. a liability which is to be paid in more than 1 year will be your long-term liability. So it will include your debentures, bank loan, etc. Fine. Current liability is to be paid in less than 1 year. So you have bills payable, bank overdraft, short-term credit or loans, creditors to whom you have to make payment. We have already discussed about creditors. Okay. Bank overdraft is when you're exceeding your borrowing from the bank more than the amount you hold with the bank. So this is how the balance sheet looks like. It's a, you can say, pro forma, which is giving information to all the stakeholders, amount of fixed asset, current asset, investment, outsiders liability or long-term liability, current liability, owner's capital, etc. So left-hand side, we have total capital and liability. Right-hand side, we have the total liabilities. Now, how do we come to know the financial position of a business? Have a look at it. Then I will be discussing it with you shortly. Is my screen visible to all? Okay. So when we are talking about financial position, how do you assess it? Simple formula, total assets equal to total liability. So we just saw the balance sheet. So from this, I come to know what is the total asset and total liability. Minded, it should be always equal. Yeah? Then we have, if I have to calculate owner capital, how do I come to know? All the assets of your business minus the outside liabilities that your business owes gives you a fair idea owner's capital. So when we say financial position, it is stronger if your assets are greater than the outside liabilities. Then comes what is income. Income, when we say, business activities, they generate different type of revenue and incomes. So what your company earned is its income. So income can be from sale of air conditioner, refrigerator, donuts that you are selling. So if I'm having a bakery business, whatever pastries, chocolate, cakes people are purchasing, for me, it is income. Okay. Fee from sale of services, interest and dividend, cash discount, rent received, and profit that I'm making when I'm selling off any investment is income for me. Then what is expense? When you wanted to make a donut, flour that you have added, sugar, milk, maple syrup, whatever you are adding to make it, make delicious donuts, that is your expense. So wages and salary you are paying to your employees, power, fuel, rent of the building, advertisement expenses, loss on the investment, whatever you are doing is your expense, which is going from the pocket of the business. Then excess of income over expense is obviously known as net profit. Excess of expenses over income will be called as net loss. And every business, like I just opened up the examples with you and I said, when you are running a business, you are running it for earning profit and not for charity. That's how you will grow your business, you'll expand your business. So net profit is always added to the capital and net loss is always deducted. asset minus outside liability is owner's capital. And like we said, capital plus net profit, capital minus drawings, plus income minus expenses. So then when I'm saying what is drawings? When you have taken out money or the assets, maybe some goods for personal use. For example, on wedding of my daughter, I am giving my daughter an air conditioner. Now my business is of manufacturing air conditioner. When one set of air conditioner I have given to my daughter in her wedding as a gift, that's a drawing, personal use. Okay, so if it is cash, if it is goods, then value of goods that you have, given to your daughter is drawing. Then what is accounting cycle? So the whole process that we talked about, identifying, measuring, recording, okay, then analyzing. So we are analyzing, documenting, recording, classifying, summarizing, and bifurcating the business transactions. It is accounting cycle. So Divya ma'am, I'm sharing a link with you. Please play the link for the participant. Just a second, ma'am. Ma'am, please play it.
Okay, just a minute.
Cereals packed with protein for muscle growth and 16 vital nutrients. Gerber cereals, a step towards nourishing brain and body.
Thank you, ma'am. So moving on to, once you have recorded the transactions, we have an account. So account, how would it look like? Here we have debit, here we have credit. So for that, we need to understand the accounting rules. Okay, so left-hand side is called as debit, as you can see, and right-hand side is credit. And on one side, there will be increase, which is to be recorded. And if there is decrease, it will be recorded on the other side. So like two sides of coin, every business transaction will have a debit and credit. Now, how do we record the transactions? Here we have types of accounts. We have nominal account, personal account, and we have the real account. When I'm saying nominal account, it's all about your expenses, your business income, okay? The rent of the building, the salary you are paying to the employees. So that is all part of nominal account. When I'm saying personal account, here we have natural persons and artificial persons. So when I'm saying Victor, or if I'm saying Divya, if I'm saying, John, Jacob, they all are personal accounts. They may be my debtor, they may be my creditor of the business. Similarly, if I'm doing business with Nestle India, I'm doing business, let's say, with Hindustan Unilever, or I'm doing business with Amazon. So these are the personal accounts. And then when I'm saying real account, this is basically for the assets and goods. So building, machinery, debtors that we have. This is all about the, you can say, real, the permanent accounts. Then what is debit and what is credit? So left-hand side, as we said, is a debit. So amounts will be written on the left-hand side, and where we have credit on the right side of the account. So every account will have a debit or credit balance. An account has a debit balance when total of debit side is more than the credit side. All assets and expenses have debit balance, and assets and expenses, this we need to keep it in mind. Expenses and assets, you have to keep it in mind, they will have a debit balance. Increase in, written on debit side, and decrease will be written on the credit side of an account. So credit balance, when your credit side is more than the debit side, we will say it's a credit balance. All liabilities and income, if they are increasing, they will be shown on the credit side. And if they are decreasing, they will be shown on the debit side. So rule of debit and credit, we said double entry system, like two sides of a coin, there is a debit, there is a credit. So here we have the two-sided effect. One transaction will be debited and the other will be credited. So what is the nominal account rule? Debit all expenses and losses. Fine. So personal account, debit the receiver, credit the giver. And the real account is saying debit what comes in, credit what goes out. Now, what does it mean? We just talked about here nominal account, if you see. Interest paid. So when you're paying rent to cash, it is going out of the business. Wages paid, wages to cash. So that is a nominal rule. If I'm saying personal account, if I purchase goods on credit from John, so for me, purchases account debited to who is the creditor? John. So that is the rule for accounting. Then next is debit what comes in, credit what goes out. If I purchased, let's say, machinery for business. So machinery is coming in, I'm making bank payment or cash payment to cash. So cash is going out of business. So method of debit and credit, we say determine accounts associated with the transaction, then decide is it personal, real or nominal account, and then record the transactions using debit and credit. So basic accounting terminologies you can further explore: trading account, gross profit, gross loss. So when it is trading account, all your production related expenses, all direct expenses are shown under the trading account. So when your left hand side is shorter than the right hand side, you will be getting gross profit. And if left hand side is greater while the left hand side is shorter, there is gross loss. Okay. Similarly, after you have got the gross profit or loss, we prepare the net profit or net loss to know what is the business income as a whole. After that, we have the balance sheet, then we have capital. If your company is issuing shares, now when the capital of company is expressed in smaller fraction, each fraction of capital is called as share. And the people who will purchase the shares of the company, they are called as shareholders. So if you're purchasing shares of maybe any company which is enlisted in the stock exchange, for you, you become the shareholder. Then we have debenture holders, we have drawings. So we have basically discussed about the various assets, like we have the current asset, fixed asset, and then there was tangible and intangible asset. So intangible assets are like the copyright, the patent, trademark that your company has invested into, and tangible assets are your fixed assets that you have procured, right? So goodwill is what is the value of your business in the market, how you are valued. Then bills payable, when you have purchased goods on credit from someone, the person has drawn a bill on you and you're making a payment for that, it's bills payable. Bank overdraft, we have already discussed. Then it was outstanding expenses. So when I'm saying outstanding expenses, you were supposed to, pay wages for the month of January, but you did not pay. So for after 3 months, you're paying. So January, February, March, you did not pay wages to your employees. When you're making the payment in April, you are actually paying the outstanding amount. So that is outstanding expense. Bill receivable is you have sold the goods on credit to someone and you have to receive money from the other party who is your debtor. So bill that you have drawn on his name, when you're getting a payment against that, that is your bill receivable. Further, we have depreciation. So whenever we are using a fixed asset over a period of time, its value is going to depreciate due to wear and tear, climatic conditions, continuous usage. So when there is a decrease in the value of an asset, that is depreciation. And we just create a charge on depreciation. We don't pay it in cash. Okay. Then we have inventory, which we have already said, it's stock. It can be raw material, it can be work in progress, can be finished stock. Then bad debts. Debtor I have already discussed. Receivables, debtors. Bad debt is when you have given the goods on credit to someone, but the person, your debtor, have not paid. So when they have not paid you the money, your money is lost. To record that loss of money, we use a term called bad debt. Creditors are the ones from whom you have purchased the goods on credit, okay, and to whom you owe money. Fine. Then turnover or sales. So if you're selling the goods, like for example, LG Electronics, if you're selling electronic items of LG, or LG as a company selling them, for them it is sales turnover. Okay. If the products you have sold, one of them is by a chance defective or got, you can say, broken while it was in delivery, the person is going to return you. Buyer will return you the faulty good. So that will become sales return. Then we have purchases. You have purchased the raw material, the fixed assets, land and building, plant and machinery. That is your purchases. But when I'm saying purchase return, mind it is on goods, not land, etc. So you have purchased furniture. Maybe you don't want that, you're returning it. Or you purchased some units of tube lights in your office. Maybe 2 of them you want to return. That is your purchase return. Then we have discount. So what is discount? Any idea that comes to your mind? What is discount? Any idea? Come on. What is discount? Can I have an answer?
Yes, decreasing the price of the goods.
Yes, Mohammed?
Discount is the fact of decreasing the price of goods. Something.
Your voice is not audible to me. I'm sorry, I couldn't hear you.
Discount.
Yeah.
Professor, you heard me? Discount is the fact of decreasing the price of something, of goods.
Okay. What else? What else? See, discount is an allowance or concession in price you are giving to the buyer. And basically you're inducing them, making an offer lucrative that they start purchasing the goods from you. And you are trying, you can say, when you want that the person should be also making a prompt payment to you. So there is, we say discount is offered. Now, generally people don't understand the difference between cash discount and trade discount. Cash discount is a concession which is given by the seller to the buyer so that he purchases the goods and he makes quick payment. Fine. And when I'm saying trade discount, Trade discount is reduction in the catalog price of goods. And like this is allowed only if the quantity ordered by the buyer is quite big. It's a bulk order and you are encouraging the buyer to make bulk purchases from you, right? This is applicable on cash as well as credit. But mind it, trade discount we never record in books of accounts. It's a floating charge. There will be a reduction in the amount which you are receiving from the client, but you will never record it. But cash discount, you will be recording in your books of accounts. Okay. So let us proceed further. Then when we are talking about the financial statements, we have the profit and loss account, we have the cash flow statement and balance sheet. In the later half, you will be studying about cash flow statement. We have already covered the profit and loss account, the balance sheet. And when I'm saying cash flow statement, it is actually telling you how cash is coming into the business and how it is going out. So basically, we have three broader categories, or you can say headings, with which you are calculating the movement of cash in your business. You have financing activity, you have investing activity, you have operating activities. So in the later half, you will be covering the details about cash flow statement. Now, financial statements are written records to convey the business activities, financial performance of a company, and it is often audited by government agencies, accountants, firms to ensure there is accuracy and you are paying the taxes properly or not. Fine. So what is the objective when you want to know the true and fair position of your business? You want to review your past performance. You want to predict the growth and profitability of your business, loan decision by the financial institutions and banks, and analyze, from the different stakeholders perspective, investor, creditor perspective, how a business has performed. So this is the basic objective of, you can say, financial statement. Further, it is also part of investment analysis. So fundamental analysis, technical analysis is there. So with which you can see the movement of share prices of a concerned entity in the stock market, how they are performing, how their shares are giving a return to the stakeholders, and likewise. Now, there was a question regarding the balance sheet, which is to be prepared. So what I'm going to do is, since we have a bit shortage of time, so I'm going to show you one example. Just give me a moment. A live example, I will be showing it to you. Hold on. So I'm sharing my screen with you all. It's a live example. Here it is. So I've taken Amazon India's example here. If you can see, here we have the current assets. So we have already talked about the important terminology which is used in preparation of a balance sheet. Here we have cash and short-term investment made by the company. Then we have the cash payments. Then we have cash and cash equivalents, short-term investments. Then we have total receivables, account receivables, a total inventory of the company, prepaid expenses, and total current assets of the company. So this is the, you can say, total current assets of the company. Then we have the long-term or we say fixed assets of the company. So PPE, plant, property and equipment, further depreciation of the company, goodwill, intangible assets, long-term investment, then total long-term assets, this information is provided. Then we have the current liabilities of the company, which includes your payables, then accrued expenses, then your payments that Amazon has to make, then current portfolio of debt it has taken. These are the short-term liabilities, which is to be paid in less than 1 year. Then you have total liabilities of the company, long-term debt, income tax that you have to pay. So finally, you have the equity. So Amazon is dealing into redeemable preference shares. This is the share capital of the company. And finally, it is the total liabilities and shareholder equity. So this gives you a fair idea how does a balance sheet looks like. I'm sharing a link with you all, which you can, in the chat I'm sharing, which you can explore to understand the capital of the company. Another example that I had taken was Nestle India profit and loss account, which you can explore on moneycontrol.com site. This is the profit and loss account of the company, which you can explore. And also you can further check the balance sheet of Nestle India, just to have an idea how does a profit and loss account and balance sheet is actually prepared, that you can see over here. You can easily compare the performance of your company in past 5 years, compare it with the competitors who are in the same industry, and accordingly you can strategize how you can improve your business performance. Divya ma'am?
Yeah, Anjali, I think
Yes.
Okay.
we can wrap up the session now.
I was about to ask. If you have any doubts, please you can ask your queries in the public chat. We would be soon winding up the session. So if you have any doubts, please feel free to ask.
Dr. Anjali, can you later share this links and
I
the
have
references
shared it
which
in
were
public
shared?
chat.
I'll share with them on mail so they have everything. at
Okay,
home.
Divya, I have shared the links in the public chat with them. So
No,
they
no, but also share it on a mail so that, because
Okay.
Zoom chat sometimes goes, so we'll share it on a mail with them.
Okay,
They
sure.
have everything at one place.
Yeah, sure. Just a second.
Thank you, Dr. Anjali. Over to you, Dr. Punita. I don't think they have doubt as of now. Okay, I think her screen is frozen. Thank you, Dr. Anjali, for a wonderful session. Participants, you would be meeting her again tomorrow for another session on accounting and related terms. Ratio, I think it's on ratio analysis. So we'll see you soon. Rather than saying you goodbye, we'll see you soon. Thank you for your session. Dr. Punita, sorry, you are priest, that's why I had to.
Yeah, I know there is some internet glitch probably at my end. So
Yeah,
probably we'll
technology.
be meeting in another half an hour. We can start the next session in another half an hour. Fine.
Yeah, so we start at 1:45 IST. Okay, we take an half an hour break.
Right.
1:45 IST. Thank you.
Right. Okay. Thank you. Bye-bye.
Bye.
Thank you all. It was wonderful interacting with you all. Looking forward for another session with you all tomorrow. Thank you.
Thank you, Professor. Thank you.
Okay. Thank you so much, Dr. Anjali. It was nice.
Thank you, ma'am.
Thank you. IT host, can you help us with the break slide?
What is the advantage?
Dr. Punita, are you here? Dr. Punita? Okay, she entered. Yeah. Good afternoon, Dr. Punita.
Yeah, good afternoon.
Participants, are you all back?
I can see many of them are there.
Yeah, I can see Than, Aprilcio. Yes. They are now, they have now got used to this time zone. I'm sure they'll be. Okay, others, please confirm. Shida, Victor, Rafael, Jose, Nitesh, Andrea, Mohammed, Sebastian. Can we start? It's almost a time. What do you suggest, Dr. Punita? We wait or we start?
I think we can wait for another 2 minutes and then we
Sure.
can
Good
start.
morning, Diva. Good morning.
I
Yeah.
see two more response. Jose. Good afternoon. Rafael is also here. I think we can start now.
Okay.
About 4-5 people. Like that. Okay. So before we begin, let me introduce Dr. Punita. So, the ring master of the day is here with us. So most of the financial understanding which you can actually apply, are going to learn from her today. She has a lot of experience in teaching academic. She has completed her PhD in business administration in 2018. After that, she has been exploring and presented so many conferences and received awards for her excellent work and published papers in several journals. While I was surfing through the list, I don't think even I can count it at a glimpse. It's just numerous. So with so much of a knowledge, I would request Dr. Punita to share some with us.
Right. Thank you, Divya, for this introduction. And once again, a good afternoon from our side in India time, but maybe good morning at your place to all of you. And once again, I welcome to the session. And I think you all had a very interesting and very fruitful session in the morning and getting you introduced with the financial accounting terms, how the financial accounts are being prepared, what is the message we are conveying through the financial statements, the different statements like profit and loss account and balance sheet. But in this session, I shall be covering about the cost part. You know, it is very important. Let me first share my screen with you. I hope it's visible to the audience. Right. So now when we talk about, understanding cost. So, cost is a very important element, like Anjali discussed in the morning. It's a very, very important element when we are doing a business. Because nowadays, it is very competitive environment. If you want to, in end of the day, the bottom line of every business is to earn higher profits. And if you want to earn a higher profits, either you need to increase the selling price or you reduce the cost. So increasing selling price is not in our hand because we are in a competitive market. So the only thing what we can do is to control the cost. So we must understand the cost behavior, only then we shall be able to control the cost. So this particular session, we shall be understanding the different aspects of cost, how the cost is there, what are the different types of cost, and how we can use the cost analysis for different decision makings, right? And I would like it to be a very participative session, and there will be certain questions which will be popped to the participants, and you should answer those questions also in between. And I would like all of you to keep your pen and paper ready along with what I am presenting, so that you are able to do certain small calculations and understand what we are doing today in this particular session, right? So let's first understand. So the basic, the theme for today's session is understanding cost and cost behavior. So with this session, you will be able to analyze the cost, understand the types of cost. You will be able to understand how to calculate the cost behavior, and what is the impact of the product cost and the period cost. This is what we are going to have the first outcome of our initial discussion today. So why very important the cost is? Nowadays, most of the organizations talk of this word, lean production. Lean production basically focuses at eliminating cost. And how do we reduce the cost? How do we reduce the cost? We should focus on eliminating the waste. Not holding the inventory more than required. If you need 10,000 kgs of raw material, but there are 15,000 kgs in your stock, why? Why are you holding 5,000 extra? You are paying extra cost to hold them, maybe the extra storage cost, maybe the extra insurance cost, all that is involved. And probably you may, there's a risk of losing that stock also. So these are the certain things which every company talks these days, that how to, reduce the cost. So this concept called lean production has been, very recent. It has picked up in all bigger organizations, especially manufacturing organizations, right? So making the product whatever we are needing. So sometimes we over process product. It may not be required by the customer. So when it is not required, then don't over process it. You may probably save some cost on that, right? Another concept which is being used these days is just-in-time manufacturing. Anybody knows about just-in-time? Anyone in the audience? Would you like to say something on just-in-time? You can speak up, you can unmute and talk. Anyone would like to say what, if you have ever heard of the word just-in-time manufacturing? This concept has come from Japanese companies, just-in-time manufacturing. Anyone? No idea?
Toyota production. Hello, Professor.
Yeah.
It's a Toyota production.
Yes, Toyota. Toyota is the big example of just-in-time. So what happens in that? Can you little update on that if you know that? Okay,
Professor,
let me tell you. So yeah, maybe there is some problem regarding the internet connection, but I can see the whole connection, but probably a little voice break is there, right? Okay, just let me tell you what is this just-in-time manufacturing. This is very interesting concept. So what happens, like just-in-time means we don't keep any stock. For example, you need 10,000 units of raw material today. So what happens, like in India or in many countries, people will keep a stock of 5 days, 10 days, so that there is no stoppage in production. But the Japanese says, why to keep a stock? Because holding the stock involves holding cost, carrying cost. So they want to reduce the cost by just in time. Means if you need the stock today at like 11 a.m., you will get the stock today morning only by 6 a.m. So that should be the tie-up with the supplier, that whenever you need the stock, that time only you will receive it. So this reduces your stock holding cost. So this is a very, very interesting concept which has come from the Japanese concept called the just-in-time. So the main objective of this particular whole exercise is to reduce your inventory cost, reduce your waste, reduce your overall time for production, because all that leads to the cost control, and cost control means reduced cost means increased profits. So that is the main objective what we are doing the business for. So now let's see how the different costs behave. Before we go on to analyzing the cost for decision making, it should be very clear to all of you what are the different types of cost. What is the classification of cost? I'm sure most of you may be knowing also, but let's understand this one by one. First is the direct cost and the indirect cost. So the direct cost is the cost which is identified with the finished product. So if you take an example of a table, the direct cost means maybe the cost of the wood which is involved, the cost of the paint, which everything what you can identify with one table, then that is called a direct cost. But there can be indirect cost. Maybe the factory, overheads, they are the indirect cost, means like maybe the supervisor was there. There was a labor who was working on manufacturing this table. That is a direct cost called the indirect cost, which cannot be identified with the finished product. So when we are calculating the cost, we must consider the direct as well as the indirect cost. Both the costs are very important. So direct cost basically is the manufacturing cost. Indirect cost is administrative expenses, the selling expenses which are behind the show, so that the product is manufactured and reaches to the customer. So that cost is called the indirect cost. Then the second classification, I think all of you must be knowing. The second classification is fixed cost, variable cost, and semi-variable cost. Fixed cost means it remains fixed. Whether you are producing a 0 unit, 1,000 units, 10,000 units, your cost will remain fixed. For example, the manager's salary, you have to pay to the manager even if you are not producing anything, right? So that will be a fixed cost, right? Your depreciation, it is a fixed cost. Whether you are producing anything or not, your machine will depreciate over the period of time. So such type of cost is called a fixed cost, and we also call it the period cost. And the other is the variable cost. Variable cost is a cost which will vary with the level of output. More units will make, the more cost it will come. For example, the material cost. Material cost is a variable cost. Like if you are making 10 tables, you may need like 5 sheets of wood. But if you want to make more tables, you need more sheets of wood. So the cost will vary with the output. That cost is called variable cost. The cost which will vary with the output. It increases when the output increases, it decreases when the output decreases. This is called variable cost. Then there may be some cost in business which is called semi-variable cost. Semi-variable means some component is fixed and some component is variable. For example, I am paying a telephone bill. Out of my telephone bill, there may be some part which is a telephone rent. This is a fixed part, but some part is dependent on the number of calls I am making. That part is a variable cost, right? So there can be, this is called a semi-variable cost, in which some part is fixed and some part is variable. You also call it as a mixed cost, right? And then there can be another classification which is called committed cost and the discretionary cost. Committed cost, which you have to do it. if you want to produce certain things, you have to do that cost, that is called committed cost. If you want to produce something, you have to spend on material, you have to spend on labor, that will be the committed cost. But there can be certain discretionary cost. Discretionary cost means you may spend, you may not spend. For example, advertisement is the discretionary cost. If the management wants to advertise, they may spend on advertisement. If they don't want to spend on advertise, they know that my customer knows me, I can directly go and sell my product to my customer, I don't need to spend on advertisement, then that is called a discretionary cost, which is at the discretion of the management. I hope this classification is clear, everybody, right? This is the first simple basic classification. Why I am doing all this? Because if you understand this basic classification, then only you will be able to do the better decision making in your business, right? So let's move on to the next cost. The next cost is a product cost and the period cost. Just like I told you, the product cost is a variable cost which varies with the level of output, but period cost is a fixed cost, which is fixed. For example, rent. I have to pay the rent whether I am doing production or not doing any production. The rent is fixed for the period. For every month, I need to pay the rent for the premises. So that type of cost is a period cost, right? Then controllable and non-controllable. I think this should be very easy, which is under the control of management, which we can control, which we can reduce. That can be the controllable cost, which is not in our control. For example, material cost. You have to purchase the material from the market. You cannot control it. Whatever price is there, you have to buy the material at that cost only. So that becomes a non-controllable. But yes, if you have a choice of suppliers, if you have a good choice of suppliers, you can control that cost by choosing the optimum supplier. So then it will become controllable cost, right? So any cost which is within the scope of management, where the management can reduce or control that cost, that will be controllable. But something which is beyond the scope of management, then that becomes non-controllable cost. The next is historical cost and predetermined cost. Like in the morning, you did financial accounting. Financial accounting is historical costing. Whatever we do, whatever we have spent, we record that. It's historical. Everything what we have done, we will record that. That is called historical costing. But predetermined is futuristic. We are determining what is the cost, what will be the cost in future. So that will call the predetermined cost. So that's another important thing when we are taking a management decision. So next is normal cost and the abnormal cost. So normal is when we are, the normal circumstances are there, what we have measured, that standard cost will be there. But sometimes there are certain abnormal circumstances, maybe a strike or maybe some delay in receiving the material. So the cost which is due to some abnormal reasons, so that will be called the abnormal cost. Okay. So now these are certain special costs which are there for, considered by the management for decision making. First is called relevant cost. Relevant, which will impact my decision. That is relevant to me. Something which will not impact my decision is not relevant to me, right? And then sunk cost, the expenditure which has been done in past. I cannot recover it. I have already spent it. So there is no time wasting on this cost because this is already spent. This is already done. The expenditure is already done. So we cannot do anything about this cost, which is called the sunk cost, the money which has already sunk, right? Then is differential cost. Differential means incremental cost. If I am producing, like maybe you can say 1,000 units, and now I am making 1,005 units. So what is the increase in the cost by making 5 extra units? That is called incremental cost, right? So what will be the increase in cost if we do increase in production? That cost is called incremental cost. That is the difference in the cost for the two levels of production, right? Very, very important. Everybody should note this next cost, marginal cost, because this is the most important cost which is used for decision making, which is called marginal cost. And marginal cost is same as variable cost. Variable cost which varies with the output. If I make more units, my cost will increase. If I make less units, my cost will decrease. So something which varies with the level of output, that is called marginal cost. Got it? And last is imputed cost. Imputed cost means which is outside your system, accounting system. It is not what we have spent, but we take that to make the different decisions. That is called the imputed cost, right? It is for example, I am doing business in my own premises. I'm not paying any rent, but to calculate my cost and to compare it with the others, I take rent into my accounts, and that will be called imputed cost. I'm not spending anything, I'm not paying rent, but I'm considering the rental cost in my decision, then that cost is called imputed cost. So this is just a basic structure you must know so that we impact our decision making. So let's go further. Opportunity cost. Maybe you must have heard about this word, opportunity cost. It is the sacrifice of what you do for an alternative, right? If I have got two alternatives and whatever cost I sacrifice to choose one over the other, that cost is called opportunity cost, right? And then replacement cost is the cost at which we have purchased while we are replacing one asset. We are selling one asset and we want to replace that asset with another asset. That cost is called replacement cost. Out-of-pocket cost, like I told you earlier, we are not paying rent, but considering into books of accounts. But if we pay rent, then that is called out-of-pocket cost. Anything what we are spending from our pocket, that is called out-of-pocket cost or explicit cost also, right? So all these, and then the future cost, which is relevant for our decision making, that is future cost. And last is conversion cost. Conversion cost is a cost which is involved in converting a raw material to a finished product. That cost is called conversion cost. Okay, anybody, any doubt till here? Any cost which is not clear, so that I can proceed further? Or if you want to have any questions here, anyone? You can speak or you can write in the chat if you have any problem here. Okay. Yes. Yes, Vita, let me explain you the marginal cost again. It is very important because whole my today's lecture will be mostly based on marginal costing. So you must understand marginal cost, right? So marginal cost is basically, let me take one example for you.
Yes. A little difficult to reply something because marginal cost is, I understand, the most important cost rather than others, So now it's difficult to explain about this.
Yes, yes. I'll tell. Yes. Give me one
Thank
minute.
you.
Okay, right. Very nice. Okay, can you see my screen now? Is my screen visible?
Yes.
Right. Okay, now let us take one example. For example, we are making a product and in the product, we need some material, right? So material cost, let us say it is costing you 100 rupees. I'm taking rupees because we are in India, we take it as rupees. Material cost you 100 rupees. Then there is a labor, which is spent to convert that material into the finished product. And we are spending 50 rupees on that labor, right? And there are certain administrative people who are there. There are certain other expenses which are there, administration expenses. So the administration expenses amounts to, let us say, 50 rupees again here. And then we have got selling expenses, right? And the selling expenses amount to 20 rupees here. So this gives you my total cost. My total cost is, you can say how much it is coming as 220. Are you all getting this? Now you can see here, material and labor is always variable. Material, because the more production we will do, the more material we will spend. The more production we will do, the more labor we will use, right? So material and labor, they are always variable cost. Material and labor will be the variable cost, right? But the administration expenses, certain administration expenses may be fixed or may be variable. Certain administration expenses, like maybe some part of it is, the more we need more people as supervisors, so they vary along with how much output we are doing. So with it may vary, but certain people are fixed in the factory, right? So administration expenses, let us say it is given that 60% of the administration expenses is fixed. 60% of the administration expenses is fixed. It means out of this 50 rupees, how much? 30 will be fixed and 20 will be variable. I hope you are getting me now, right? So this 50 rupees is my administration cost coming, and what we have calculated, out of this 50 rupees, 60% is fixed. Out of 50, 60% means 30 is fixed and 20 is variable. Clear? And similarly, the selling expenses says that 50% is fixed. 50% you have kept, the delivery van is there. The delivery van charges are there. We have to spend on its depreciation. We have got a salesman. We have to spend on his salary. That is fixed. So 50% is fixed and 50% is variable. So in that case, 10 will be fixed and 10 will be variable, right? So out of this now, 100 rupees is variable, material 50 rupees is variable, administration 20 is variable and 10 is variable. So total variable cost will be 180. Out of 120, right, you can say the variable cost is coming as 180. And this is nothing which is called marginal cost. Marginal cost is the variable cost. I hope everybody has understood this thing now. The marginal cost is called the variable cost, and all important costing decisions, every organization should be able to identify what part of their cost is fixed and what part of their cost is variable. If you are not able to identify this thing, you will not be able to use marginal costing. So very important, you must know material and labor will always be variable. But when we are talking about administration expenses and selling expenses, right, these expenses, we call it as, even some other factory expenses can be there, right? So all these expenses, they are called overhead expenses. Indirect costs, what are they called? Overhead. Overhead expenses, the factory overheads. So all these expenses can be fixed or variable. So whatever is the variable component is called marginal cost. Any doubt in this now? Anybody? Is the marginal cost clear? Shall I proceed further? Okay. Right. So these are the basic elements of cost: material cost, labor cost, and the expenses. Like I was telling you, the material cost, it includes direct and indirect, labor cost, direct and indirect, expenses, direct and indirect, right? So it can be, which can be directly identified, which cannot be directly identified. And when we take the direct expenses, it is called the prime cost. And all other indirect costs are called the overhead costs. Just like I told in my previous example, all other are called the overhead costs, which includes production overheads, administrative overheads, and selling and distribution overheads. So these are the different types of expenses which can be there in any manufacturing organization, right? So direct material, direct labor, and direct expenses will be called the prime cost, and all other expenses, indirect expenses, are called overheads, which may include production overheads, administrative overheads, and selling and distribution overheads. So now let's see how the cost moves, how the cost flows in an organization. You can see the chart here. So we have got three heads: material cost, direct labor, and manufacturing overheads. When all the three are used, we have got work in progress. The things start moving, the material start converting into finished goods by the use of labor and by use of other expenses. Then we have work in progress. And when the work in progress is converted, then it comes to the finished goods. And from the finished goods, we are going to sell these goods. So that will give you cost of sales. Clear? So this picture is there. So now let's see how it happens. So this is how the cost flows in accounts. This is how the cost flows in accounts, right? See here, first we have the raw material. In the raw material, we have opening inventory. There must be some stock of raw material with you when you started your production this year, right? And then you made certain purchases. At the end of the year, there is some closing stock with you. So opening stock plus purchases minus closing stocks gives you how much raw material we have used. How much raw material? For example, let me take an example. If you have opening stock of 100 units, right? You have raw material of 100 units with you. And during the year, you purchase 1,000 more units. So total units we have is 1,100. And after the end of the year, after the end of the month or year, you have 200 units still with you. It means how many units you have used? 900 units are used. So that is called raw material used. Am I clear, everybody? Raw material used. Opening stock plus purchases minus closing stock gives you raw material used. So this will be giving the raw material used plus the labor and the overheads. So this will give you cost of goods manufactured, right? So similarly, from the cost of goods manufactured, again, every stage we are doing the same step. Opening inventory plus the cost minus the closing inventory, you move on to the next cost, right? I'll explain you this with an example. We will get an example. See here, everybody, right? So this is a schedule of cost manufacture. See here, the opening raw material was 10,000. The opening raw material was 10,000 and they purchased raw material of 40,000. So how much raw material is available? Yes, Mohammed, I can see your hand is raised. Yes, you want to say something?
Professor, please, can you explain again factory overhead? What does it mean? I know it's a margin cost, but really, what does it mean? Factory overhead.
Production overheads.
Production overheads.
No, what you are asking? Sorry, once again.
Factory overhead or production overhead.
Production overheads, yeah, I'll tell you. Yes, I'll tell you. The production overheads, you can see here. Here it is written, manufacturing overheads, these are production overhead. I'll give you an example, right? The factory rent, the factory lighting, the factory insurance, all the things, what we are spending in the factory, in manufacturing, they all are called manufacturing or production overheads. Got it? Right. So you can see here, see now this is how the cost flows. The whole structure you will be able to understand. First, we need raw material to produce the goods, right? So this is the opening stock of raw material. This is some more raw material we purchased during the year. So total stock of raw material available was 50,000. And in the end, remaining raw material was 5,000. It means how much raw material we used for production was 45,000. So raw material used for production was 45,000. And now this is the direct labor cost. So direct labor cost, when we have to convert this raw material to finished goods, we need the labor. So the labor cost is 65,000. Now here it is written manufacturing overheads. Manufacturing overheads is what we spend in factory other than material and labor. Maybe factory lighting, factory heating, fuel, power, whatever we are, electricity, whatever we are using in manufacturing the goods, that all is called manufacturing overheads or production overheads. Got it? Right? So we are spending this cost, manufacturing overheads. So then we get the total manufacturing cost. Total manufacturing cost. But at the end of the period, there may be certain units which are work in progress. Work in progress means which are not complete. So we will adjust our cost with the work in progress, add opening work in progress, less closing work in progress. Because these are units which are still incomplete, we cannot take them further for selling, right? So this will be adjusted here only. So these are the goods which are fully manufactured and ready to sell. The cost is 1,90,000. Clear here? Shall I move forward? Right? So we have what? 1,90,000 for the goods. We have the cost for which we have completely manufactured. We have already adjusted the work in progress. Okay. Now see here. Now we got cost of goods manufactured from the previous slide. You can see here 1,90,000. I'm moving further, right? So now we have got, these are the cost of the goods what we produced this year. Yes, Mohammed, you have again raised your hand. Yes, you want to ask something?
Professor, in the last slide, in the end.
Yeah.
Yes. Beginning work in process cost. What means and
yeah.
work of
okay, right. Let me tell you. Like we have this raw material in the beginning. We are not starting business in this year only. Maybe the first year of the business you will not have any stock in hand, right? But now when you move on to the next year, so maybe it is a fourth year of our business. So in the fourth year, so at the beginning of the year, you will have some work in progress. The units which were incomplete last year, so that is called work in progress. Okay, which were incomplete last year. So that is my opening work in progress. The units which are incomplete this year, that is my closing work in progress. The units which are incomplete cannot be sent for sales, right? So that is why we will adjust them here. Okay. So we add the opening work in progress because we shall be completing these units this year, right? But we subtract the closing work in progress because they are still incomplete. They cannot be sold. So the units which can be sold are this 1,90,000 units can be sold, which we produced this year. Okay. Right. So the next you can see here at the beginning. Now that was raw material. Second thing was work in progress. Now the third thing is finished goods. Now at the beginning of the year, there must be some finished goods lying which were not sold last year. There must be some stock of finished goods which were not sold last year, right? So that is called finished goods inventory. Beginning, the units were fully produced but not sold, right? So unsold inventory. So the closing inventory of last year becomes the opening inventory of this year. So you have 30,000 units, rupees 30,000 opening inventory, and then 1,90,000 what we produced in this particular year, right? So total inventory available to sale was 2,20,000. Total what was available for sale was 2,20,000. But 5,000 is still in stock at the end. It means how much goods were sold? 2,15,000. Goods costing, cost of goods sold. Goods costing 2,15,000 were sold this year. Is the chart clear? Any doubt, anybody till here? This is very, very basic thing. If you don't understand this, probably will not be able to move further. Once again, I'm showing the picture. If any doubt, you can raise hand or you can ask me here again. We started with opening raw material. We purchased the raw material. We subtracted the closing raw material. So this gives you how much raw material we have used. Then we put on the labor and manufacturing overheads to convert the raw material. So this is your manufacturing cost. Then we adjusted the work in progress. Some units which were in progress last year are added. Some units which are in progress in this year are subtracted. So these are the completed units of this year, 1,90,000. And then these are finished goods, 30,000 finished goods which were for the last year. We added them. So how many goods we can sell now? 2,20,000. But 5,000 are still unsold. Finished stock, ending, closing. It means the goods what we have sold this year, they costed us 2,15,000. I hope the process is clear, everybody. Okay, so let's move further. The more you will learn, the more you will see, you will understand better. So now comes the income statement. So we have here from seen whatever goods we are selling, it has costed us 2,15,000. Whatever goods we are selling, it is costing us $2,15,000. Now see here in the next slide. So this is your income statement. Now our sales are 5 lakhs for the year. From the 5 lakhs of the year, you can see here 2,15,000 was your cost. So 5 lakh minus 2,15,000, you get a gross margin of 2,85,000. Everybody clear this thing? So we calculated here 2,15,000. Our sale value is 5 lakhs. Cost is 2,15,000. We are getting a gross margin of 2,85,000. And from that, we will subtract your indirect expenses. Like I told you in the beginning, selling expenses and administrative expenses are your indirect expenses. So that will be subtracted now, and $1,10,000 will be your net income. So this is how you make the income statement, taking care of all the different costs, starting from raw material to the finished goods, to the manufacturing cost, and to the administrative and selling cost. Any doubt? Anybody? Anybody wants to put any question here? Anything? Come on, please feel free to ask anything. You can write in the chat box, or you can just raise hand and talk. That will be much better. Okay, so let's go further then. I hope things are a little clear. Okay. See a small example. Although had it been a offline workshop, I would have asked all of you to calculate. I don't know how much you will be able to calculate here. See, you are the president of Folex Limited. Your new accountant has presented the following statement. He says, sir, the sales is 3 crore 330 lakhs, and the expenses are 297 lakhs 50,000, and we are getting a net income of 32 lakhs and 50,000. But you are a president, you will look into the more details. So you have checked from your department that they have manufactured 60,000 units at a cost of 210 lakhs. And the sales department said that you have sold 55,000 units at 550 rupees or dollars each. And your monthly administrative and marketing expenses are 37 lakh 50,000. Okay. Anybody can try to calculate net income? I can give you 1 minute to try. Yes, come on. Scribble with the pen and pencil and try to find out. I'll give you 1 minute, then otherwise I will help you with this. Very good. Give it a try. You can make a statement like this: sales minus cost of goods sold by reducing the inventory, then find the gross profit, and then other expenses you can subtract and find the net income. This is how you need to find out. I've given you the hint here. So this is a question once again. Give it a try for 1 minute. Okay, anybody can tell me what will be the sales? How much will be the sales? We are selling 55,000 units at a selling price of 550 per unit. 55,000 units at a selling price of 550 per unit. How much is the amount of sales? Now, anybody? I've got a calculator here with me. You can use your mobile. If you don't have calculator, use a calculator in your mobile and find out. Anybody? How much is the sales value?
Just a minute, Professor.
Okay, good, good, good. At least somebody is trying. I'm happy. Yeah. So sale is coming as 302 lakhs 50,000.
Yes.
So how much it is coming? So this is your sale value, 55,000 into 550. Everybody got this?
Yes.
Right? Right. Okay. So now let's see the next slide. I have done this sum for you. See here. So sales is this much. 302 lakhs 50,000. Now we have to need to find out what is the cost of goods sold. See here, how many goods were made? 60,000 units were made at a cost of 210 lakhs, 210 lakhs, right? So what is the cost per unit? So what is the cost per unit? Cost per unit is like 210 lakhs, 60,000. It is giving us 350 per unit. The cost price is 350 per unit, 350 into 60,000. It gives you 210 lakhs. It is as per information given. Now you can see here, we have manufactured 60,000 units, but we have sold only 55,000 units. So what are these 5,000 units then? Anyone? What are these 5,000 units? We have manufactured 60,000, but we have sold only 55.
It's a rest. There is a rest.
Sorry?
Rest of.
Yeah, rest. What is that called? That is called closing stock.
Closing stock.
Okay, so that is called closing stock. So we have 60,000 units we have manufactured, but we sold only 55,000. So we have a closing stock of 5,000 units in hand, which are not sold. Okay, so what do we do when we need to find the cost of production, the cost of goods sold from the total manufacturing cost of 210 lakhs? We will reduce the value of closing stock, the stock which we have not sold. 5,000 units, what we have not sold, it costed 5,000 into 350 per unit. It costed us 17 lakh 50,000. It costed you 17 lakh 50,000. So how much will be the cost of goods sold? 210 lakhs minus 17 lakh 50,000. The cost of goods sold is 192 lakhs 50,000. I hope everybody is not burdened with too many figures. Hope you are understanding something, right? Sales minus cost of goods sold will give you gross profit or gross margin, right? Sales minus the cost of goods sold will give you gross profit and gross margin. From the gross margin, we will reduce your marketing and administration expenses, which is given as 37 lakh 50,000. So from 110 lakhs, we reduce the marketing and administrative expenses. Your net profit is 72 lakhs 50,000. Anyone, any doubt if you are not understood? You need to little scribble on your paper. You need to note the figure. Yeah.
Can you repeat the explanation? Less, this what we say.
This is less closing stock. Yeah.
Closing stock.
This is less closing stock.
This,
the stock which is not sold. So we will be reducing the cost. We will be reducing.
Yes.
Got it? See, once again, we are selling how much sales we are doing. We are selling 55,000 units into 550 per unit, right? This is your sale value, okay? And then, but we have manufactured 60,000 units at a cost of 350 per unit. So this is given in the problem. It is costing you 210 lakhs. But out of 60,000, we are selling only 55. So 5,000 is your closing stock, right? So we need to reduce that cost. We have not sold that. So we are subtracting the value of closing stock, which is 350 into 5,000. This comes at 17,50,000. Okay. So your net cost of goods sold, it is called cost of goods sold. We are selling 55,000 units. So this 55,000 units cost you 192 lakhs 50,000. Okay. So sales minus cost of goods sold gives you gross profit. You can say what is the formula here for gross profit? Right here, sales minus cost of goods sold. So this gives you gross margin. Got it?
Why, Professor, why we make sales? Sales is the unit sell, and the closing stock is the rest. Why make these minus?
Okay, why make this this minus, sales minus? It's okay, it's okay. Probably you're playing with numbers for the first time, I think. Okay, fine. Let's do this again. I think it's quite interesting. You're finding, see here, once again, let's go to the question back. Right. So you have understood that we manufactured 60,000 units,
Yes,
but
clear.
we sold only 55,000 units. This is clear,
Yes.
first thing,
Clear,
right?
clear.
Right. Okay. Now let's come back here. So we sold 55,000 units at a cost of 550 per unit. This is your sale value.
Yes,
Now
yes.
you have manufactured 60,000 units, right?
Yeah.
And the cost was 210 lakhs. So
Yes.
it means it was costing 350 per unit.
Yes.
Clear? Right. So now we are producing 60,000, but selling only 55,000. It
Yes.
means 5,000 units we are not selling.
Yes.
Right. So 5,000 is my stock value.
Yes.
Right. So what is the value of my stock? 5,000 into 350. Cost price is 350 per unit.
It's
210 lakhs divided by 60,000. 210 lakhs divided by 60,000. You will get 350 per unit.
Yes,
Right.
300.
Yes, yes, right. So you get, this is the value of your closing stock, which you have not sold, So we need to find out.
350 multiply 5,000 units. This
Yes, is the value of the
1,000.
closing stock. Yes,
Yeah,
it is 7. Yeah, this is the value. Okay.
Value,
So
yes.
from the total cost, this is the total cost. We reduce the cost of the closing stock. We get the cost of goods sold.
Okay, the cost. Okay, clear. Yes.
Yes. Okay, got it. Now this is your cost of goods sold. So from the cost of goods sold, so we subtract from sales the cost of goods sold, we get gross profit. Got it. Okay, good. I'm happy that finally I'm able to make you understand. So from sales, we reduce the cost of goods sold, we get the gross margin. From the gross margin, we reduce the administrative and marketing expenses, we get the net profit. So your net profit for this particular was 72 lakhs 50,000. I hope this is a basic cost structure which you should understand so that you can take it further, right? Okay, so let's move further. Right. So now the second aspect, like I told you, we must understand how the cost behaves. Either it will be a fixed cost and a variable cost. I have already explained you earlier also, right? The cost which changes with the production, that is called the variable cost. As production volume changes, some cost increase or decrease and other costs remain same. To understand, like here, fixed cost. Whatever is the level of production, you can see here, whether I am producing 0 unit, I am producing 2,500 units, I am producing 5,000 units, I am producing 7,000. My fixed cost remains same. This is called fixed cost. 10,000, right? Number of units. But when the units, the cost varies with the output, right? So fixed cost per unit will keep on decreasing. The fixed cost will keep on decreasing. Okay. And then if you see here, variable costs will increase as the production increases. If the production is this 2,500, the variable cost is 50,000. Production is 5,000, variable cost is 1 lakh. Production is 7,500, variable cost is 1,50,000, which varies with production. So that will be called variable cost. Okay, everybody clear? Right? So something which varies with production is called variable cost. Something which remains fixed, whatever level of production we are doing, that is called the fixed cost. Okay. Now let's, okay. All of you can note down this equation if you want, so that you will be able to understand what will be the cost equation. This is called a cost equation. The cost equation is equal to Y is equal to A plus BX. Y is your total cost. And what is A? A is your fixed cost. Plus B is your variable cost per unit. All of you can note down this equation, everybody. If it will be better if you are understanding cost accounting here. So this is a very interesting equation. Y is equal to A plus BX. Y is your total cost. A is your fixed cost. B is your variable cost per unit. And X is the number of units produced. Once again, I'm repeating. Y is the total cost. A is your fixed cost. B is your variable cost per unit. And X is the number of units produced. I hope everybody has noted. Mohammed, you need to unmute. Yeah.
Yes, just a little question. When you return to the 20th slide, the figure, yes. The slide before 20. Yes, just I would like to know the fixed cost in total production is constant, but concerning 1 unit is a variable. How this?
Okay, see here. I'll explain you with an example then. Let me set a slide here. Right. So we have taken the fixed cost is 10,000, right? Okay, right. Now, if I make 1,000 units, if I make 1,000 units, so what will be my cost? No, not I'll say. What will be my fixed cost per unit? What will be my fixed cost per unit? So 10,000 divided by 1,000. So how much it will be? 10 rupees per unit. Got it? Right? Now fixed cost will remain fixed. Fixed cost will remain fixed only. 10,000 will 10,000. Now I make 2,000 units. Now I make 2,000 units. What will be my fixed cost per unit again? Yes, Mohammed, you tell me now.
5.
Yes, that is what it was shown here. Divided by 2,000, it is 5. So this is what was visible to you here. You can see here, the per unit wall cost will keep decreasing when you will increase the output. I hope the graphic is clear now.
Yes, this is due that the total cost is fixed. As we produce.
Yes, right. Whatever units, number of units we are producing, fixed cost will remain fixed. So what will happen? The per unit fixed cost will keep decreasing. The more units we will make, if we make 10,000 units, the fixed cost will come to 1 rupee per unit, right?
And Professor, just a little question. The fixed cost really, it's not the fixed, the cost of raw material and fixed cost really in the factory.
No. Fixed cost is, I told you earlier. I told you earlier also, right? I told you earlier also that what will be the fixed cost? Fixed cost will be only overhead. Administrating, selling, and overhead will be part of fixed. Material and labor are always variable. They will always vary with the output. They will never be fixed. Okay, you will use material only when you will do the output, and the more output you will, the more material you will use, right? So material and labor will not be fixed cost. Got it? So let's. So I hope this is clear now, right? Okay, so this was the variable cost. So see here, variable cost increases with the increase in output. Now see, variable cost per unit will remain same. It is opposite of fixed cost. Variable cost per unit will remain same. Did you get this? Yes. The production keeps increasing. The more production, more variable cost. But per unit, it will remain same. It will be 20 rupees per unit. It will come for 20 rupees per unit for all, whatever we are making. Right? Okay, good. So I hope all of you have got this.
Equation, this total
Yes.
cost, fixed cost plus variable cost multiply with X, which is the number. It's equation used in the calculation of costs in factory.
Yeah. I'm going to show you how we are going to use it. We are going to do one example to understand how we are going to use this equation. Okay. I hope all others are also understanding. Probably only Mohammed is responding to me. But I hope everybody else is also understanding. In case anybody else has any doubt, you can raise hand or ask me here.
Professor, it's a new domain for me, but it's a very amazing. Yes.
Okay. Let's see one example to understand this equation. Let's see. Okay. So you can see here, everybody is reading this exercise. This is a work for you people. Use that equation, cost equation. Sister Aaron and Teresa have started separate companies in the same city, right? And each company provides the same, they do the party planning for their business, like wedding, birthday parties and holidays and other occasion. And they have, both of them are, accounting literate, they understand about accounting and cost. So they have made their own cost equation. Erin has made a cost equation of 2 lakhs plus 20,000 per planning hour. But Teresa has made a cost equation of 12,500 plus 3,000 per planning hour. Anybody can tell me what is the difference in the two equations? What is the difference in the two equations? Just now I gave you this equation. Y is equal to A plus Vx. So this A plus Vx is defined by Erin and Teresa. See here, what Erin says, 2 lakhs plus 2,000 per planning hour. But Teresa says 12,500 plus 3,000 per planning hour. Any comments? Any comments? Very interesting. What is the difference between the two sisters' equation?
I think the first difference is the fixed cost.
Very good. So the first difference is the fixed cost. See, Erin is working with more fixed cost and less variable cost, whereas Teresa is working with less fixed cost but more variable cost per unit. Okay, anyone can tell me how it will impact their profits? Although I will show you here, but let me see if you can think. If you can think. Maybe it's a wrong answer. No worries. Just try something, some answer. How the cost will behave for them? Okay, very good. Okay, let me see. Okay, now this part is very clear to all of you that she has taken higher fixed cost, but Teresa has taken lesser fixed cost, right? So now we need to compare the two sisters if they both do 130 hours planning. So let's see how the cost will be there. Okay, see here. See here, everybody. Erin's equation is 2 lakhs fixed cost plus 2,000 per hour. How many hours planning they are doing? 135 hours planning. So this comes to So 2 lakh plus 270 lakhs. So it is coming as 470 lakhs cost for Erin. For how much? 135 hours. But for Teresa, the fixed cost is 12,500, right? And the variable cost is 3,000 per hour. So how much it will cost to her? 3,000 into 135 plus 12,500. The total cost for Teresa will be 417,500. One very important outcome of this particular comparison is
we should use robots in production than men.
okay.
Right. Reduce the fixed cost.
Right.
Yes.
Okay, very good. So Teresa has reduced the fixed cost. So, you know, when you reduce the fixed cost, you will reduce your total cost also, end of the day, right? But very interesting takeaway, although this will come in the next part when we are doing the break-even point. What happens? It will take more time for Erin to start earning profit, because she will be earning profit when her fixed cost is 2 lakhs. She will start earning profit after the 2 lakh is recovered. But Teresa will start earning profit quite early because her fixed cost is only 12,500. Right. So this is a very interesting take here. So if the fixed cost is less, you start earning profit earlier. But if fixed cost is more, you need more sales to cover this much fixed cost. So that will be the difference here between the two sisters. Although both of them are earning, maybe I don't know about what is the sales point is not given in this question here, but we are just comparing the cost. But end of the day, if we compare with their sales, so the point here is anyone who is having the lower fixed cost will start earning profit earlier as compared to the person who is having more fixed cost. Because more fixed cost, you need more sales to cover that cost, right? Then only after that you shall be starting earning the profits. Got it? Clear? Right? So I hope this first part is very clear. Right. So now let's, if you want to take a 5 minutes break, we can take a 5 minutes break, or if you want me to continue, I can continue, however you want. So because now the next part of this thing will be decision making, how we analyze the cost to make the different decisions. That's really more interesting part of it, but it all depends on you. If you want to take a 5 minutes break, we can take a 5 minutes break. Is it okay? Yeah, so we'll meet in another 5 minutes then. Fine. I'm here only. If anybody has a doubt, you can talk that. We can discuss that in 5 minutes. Others, if you want, you can take a break. Let me quickly, once again, run the slides so that if anybody has any doubt, you can ask me. This is what all we discussed in the previous 45 minutes.
डॉक्टर पुनीता,
Yes.
स्लाइड शेयर में डालने का ट्राई करो ना.
If I put on slide share, then probably if I have to do calculation and do then something, then that is not, workable.
Okay, so you want to write on the screen. That's why you are saying
Yeah.
you can still annotate and write even in slide share mode.
But probably I don't know that. I'm not able to do that.
No issues, no issues.
Huh.
Okay. And after this, can we go for a short break?
No, we are on a break only.
Already on a break.
Yeah. This is a 5 minutes break. I'm just running the slides for people who are there, but we are on 5 minutes break.
Okay, okay. Thank you.
Clear, Professor. Clear.
So shall we start then?
Let's
So-
go.
Right.
Let's go.
Okay. I hope everybody is fine. So that was a refreshment for 5 minutes. By the time I repeated all the slides also. So now we are going to understand how we can analyze the cost further, which will help the management to take the different decisions, right? Okay. So now let's see here. So in this session, probably it's quite lengthy, although I've got a lot of things to tell, but time is very short. Let me see how much I can cover and how much you can understand. See, a lot of things are there. So let's see. So first of all, very important thing you will be understanding is use of contribution margin. Until in financial accounts, we have gross profit or gross margin and net profit, net margin. But in cost accounting, we use the concept of contribution margin. So I'll tell you how this is there and how we use this contribution margin for decision making. And then we will also understand CVP analysis. CVP analysis is cost volume profit analysis. How the cost varies with the volume and how it impacts the profit. So that is what we are going to understand in this particular session. And then how the company break evens. So break even is a point where the point of no profit, no loss. After that point of sale, the company starts earning the profit. So that is called break even point. So all these, and then how the different decisions are made using this concept. This is what I'll be discussing in this upcoming session now. So let's see. First here is cost volume profit analysis, right? So what are we going to, what are the different things, what are considered for this cost volume profit analysis? What are the price of the product? How much volume of the products can we sell? What is the per unit variable cost? What is the total fixed cost? And what is the product mix in case we make 2 or 3 units in an organization? What is the product mix? So you must know all these things, then only you will be able to use this cost volume profit analysis. So I think for every company, if you are a manager, you must know what is the price, how much you can sell, what is the volume, how much is a variable cost per unit, how much is the total fixed cost per unit for your organization, and how many units of each type you can sell or make. So this particular knowledge, you should be knowing these factors then only we will be able to use the cost volume profit analysis. See here, this is a comparison of traditional financial statement with the contribution margin financial statement. In the traditional, just now what we did in the previous session, sales minus cost of goods sales will give you gross profit. And then we subtract selling and distribution and administration expenses, it will give you net profit. Just now we did one exercise, the same thing, right? But now, when I am doing cost volume profit analysis, I do it with the method called contribution margin. And what does this contribution margin says? We divide the cost, all cost, into two components, variable and fixed. Right? How do we take it? Sales minus total variable cost, manufacturing variable cost, selling, administrator, all type of variable cost we take. Right? Sales minus variable cost is 400. It will give you a contribution margin of 600. Sales minus variable cost is everything. Everybody should note down on the papers this thing, because I'm going to use this further. Please note, everybody, in your papers. Sales minus variable cost is equal to contribution. Sales minus variable cost is equal to contribution. All variable, maybe manufacturing, maybe administration, maybe selling, all variable cost. And contribution, next equation, contribution minus fixed cost will give you profit. Contribution minus fixed cost will give you profit. Okay, done? Understood? Right? So these are the two things. This is a traditional method, what we did in the previous first half of our session. But now we are going to use this method, which is called contribution margin method. And this is the method which is used mostly for decision making. The contribution method, the contribution margin method, right? Okay. Now see here, let's understand this. This one case study of Happy Days game company. The company makes the games for the kids. See here, the sales are given. 8,000 units they are selling at a total price of like 1 lakh rupees. The selling price is 12.5 per unit. Less variable cost, 8,009 rupees per unit is your variable cost. 8,000 into 9, 72,000 is your variable cost. So what will be the contribution? 1 lakh minus 72,000, 28,000 is your contribution. Sales minus variable cost is contribution. Contribution minus fixed cost is your net profit. Everybody clear? Everybody clear this thing? So now we have changed. Earlier we were taking sales minus cost of goods sold, gross profit, cost of goods sold minus selling and administration expenses, net profit. But now what I am saying, sales minus variable cost, all variable, maybe manufacturing, maybe administration, maybe selling. Every variable cost will take here, right? So this will give you a contribution margin. Contribution margin minus fixed cost will give you a net profit. And here you are having contribution margin of 3.5 per unit. Selling price minus variable cost, contribution margin of 3.5 per unit. Is the word contribution clear? Anyone can write what is contribution in the chat box? Let me see. Quickly. What is contribution? What is contribution? Write in the chat box. Anyone can write. What is contribution? Okay, I'm waiting. Very good. Sales minus variable cost is contribution. Very good, Mohammed. So I take this as an answer given by everybody. Mohammed is representing all. Okay. So you see here. Contribution margin per unit, 3.5 is the contribution margin. Sales minus variable cost, 28,000 is contribution margin. And since we are selling 8,000 units, 28,000 divided by 8,000, contribution margin per unit is 3.5. So this is total contribution margin 28,000. Contribution margin per unit, we divide by the number of units sold. We get contribution margin per unit 3.5. Okay. So what contribution margin per unit explains? Very interesting, very, very interesting. Every additional game sold by the Happy Days company will add 3.5 to their kitty. Why? Why? See here, if I am selling 8,000 units, I am earning a profit of how much? 8,000. And you see all? The net income is 8,000. If I sell 8,001 unit, one more unit I will sell. What will be my profit? One more unit I sell. If I sell one more unit, there will be no increase in the fixed cost. Fixed cost remains fixed. Whether I make 8,000 units, I make 10,000 units, I make 2,000 units. Fixed cost will remain fixed. What will change? Only my variable cost will change. Now see here. See here. Now, if I am making 8,001 units, how much will be my sale? 1,12,000 rupees 50 paisa. 12.5 is my selling price. 9 rupees is my variable cost. So 9 rupees, 72,009 rupees will be my variable cost. Fixed cost remains same. And what will be my net profit? 8,003.5. So you can see here, what is this 3.5? 3.5 is nothing but the contribution. So what does this contribution tell us? With every 1 unit increase in sale, the contribution will increase by 3.5. Some people have found it like a bouncer. I don't know. Anybody? Anybody? Yeah. Any doubt? Anyone? So once again, I'm reading this. We'll do it a little further. Once again, what does contribution margin tell us? Every 1 unit increase in sale will increase the profit by contribution 3.5 because there is no increase in fixed cost. Fixed cost remains same. So it is very easy for the company to judge. Every time we increase the sale, the increase in profit will be equal to the contribution margin increase, contribution margin per unit, right? So this is how we are going to use this contribution margin in the further. So now let's take this, let's further, little more understanding. If the sales increase, now we have taken that the sale is increased by 100 games. The sale is increased by 100 games. How much profit will increase? 100 into 3.5, simply. 100 into 3.5 because the fixed cost will remain same and your contribution will increase by 100 games into 3.5 per unit. So 100 into 3.5, your profit will increase by 350 rupees or dollars, whatever you can say. Got it, everybody? Right? So very interesting concept. If we reduce we have taken this concept from here, I'm coming back here. So what is the concept called? Contribution margin, sales minus variable cost. Very interesting concept. Nothing you need to calculate. Calculate contribution margin per unit. Every time you keep increasing the sale, you can tell what is the increase in your profit directly because fixed cost will remain fixed. Whatever we make, fixed cost will remain fixed only. 20,000 will remain 20,000 only, right? So with 100 games increase, you get a profit of 350 more. Okay, let's see here. If 100 games, we are selling 200 games less. Sales decrease by 200. Yes, how much will your profit decrease? If we sell less 200 games.
700. 700.
700, 200
3.5.
into 3.5, 200 into 3.5. With every one game less sold, we will be reducing the profit by 3.5. So 3.5 into 200, 700. Getting, everybody getting, right? So this is how very interesting, contribution is very interesting, how quickly you can check whether you will be increasing profit or decreasing profit and what amount it will be impacting, right? So this is called cost volume profit analysis. Whatever volume, we are changing the volume of games sold. Whenever we change the volume, first in the first case, we increase the sale by 100, we got the impact on profit. The profit will increase by 350. In the second example, we decrease the game by 200. We know that our profit will decrease by 700. So this is called cost volume profit analysis. Got it? The first word is clear. Cost volume profit analysis. Right. See here now. Now this is called contribution margin ratio. Everybody please note down this formula. PV ratio, profit volume ratio, or we call it as contribution margin ratio. Contribution margin divided by sales into 100. Contribution margin divided by sales into 100. This is called PV ratio, profit volume ratio, or contribution margin ratio. Very important in decision making. Many decisions in the current companies, when they are there in very competitive atmosphere, they can use this ratio to take varied decisions. Okay. So in the current example,
Professor,
yes,
this ratio or this KPI, what indicates for a company? It's indicates that the sales good goes in the right
yes,
side.
yes, we are going to use this. I'm taking a lot of examples to explain this. Don't worry, right? So here you can see here. Just let me tell you, 1 lakh was our sale, 72,000 was variable cost, and contribution margin was 28,000. So what is the contribution margin ratio? 28,000 divided by 1 lakh into 100, it gives you 28%. Contribution margin is 28%. Means with every 100 rupees increase in sale, your profit will increase by 28%. With every 100 rupees increase in sale, your profit will increase by 28%. Okay. Profit volume ratio. The change in volume of sale, how much profit will change? The profit will change by this percentage. Mohammed, I hope you got it now, right? So with the change in volume of sale, how much profit will change? With 100 rupees change in sale, 28% change in profit will happen, right? Right? If 100%, 100 rupees more sale is there, profit will increase by 28 rupees. If 100 rupees less sale is there, profit will decrease by 28 rupees, like that way. Okay. So let's see here. Now we are going to apply this contribution margin. You know, everything we learn to apply in business. So let's see. For every rupee change in sale, contribution margin will increase or decrease by the contribution margin multiplied by the increase or decrease in sales. You can see here what I was telling. If sales decrease by 200 units, what will happen? The decrease in contribution margin and the net income, just like you did. You told me 700 rupees, 200 units. So 2,500. See the sales decreases, 200 into 12.5. 2,500 into 28%, 700 is the decrease in sales, right? So that is the interesting thing to calculate this ratio. Okay, I hope it's clear. The decrease in sale, here the sale decreased by 2,500 for 200 units. So what will be the decrease in profit? 2,500 into 28%, 700. So that will give you the decrease in profit, right? Okay. We'll use it further. We'll learn to use this further. Now, we are the same company. We are the Happy Days company who is selling 8,000 games right now. The CEO of the company is not happy. You can see here. Currently, we are earning a profit of 8,000. Currently, we are earning a profit of 8,000, maybe 8,000 rupees or dollars, whatever currency you want, any figure, right? So the CEO is not happy. 8,000 is not enough. He says, come on here, why only 8,000 profit? And needs to consider option to increase the net income. Right. So what can be the options? What can be the options to increase the income? Anybody? See here. What can be the options? How can we increase the income? See here. The three options are given. She says that let us try to reduce the variable cost. If we reduce the cost, we increase the profit. I hope all of you know this. If we reduce the cost, we'll be able to increase the profit. So first option can be let us try and reduce some variable cost. The second manager says, ma'am, let us increase the sales by giving more sale incentives. Let us increase the sales by giving more sales incentive. More sales means more profit. The third manager has given a suggestion. Let's increase the sale by improving the more features and more advertisement. Then we will increase, more sales means more profit. Everybody has understood the options? So there can be different options. There can be different options to increase the profit. So first option is on, let's analyze the options one by one. Okay, now we have decided option one. Let's try to reduce the variable cost. When the variable cost is reduced, contribution margin will increase. Now, what Happy Days is how they are trying to reduce the cost? They have find a less expensive supplier of raw material. They reduce the amount of labor used and they use a low wage employee. These are the different options. These are the different options how they can reduce the variable cost. Right? Either they go for a supplier who gives you little cheaper. Okay. What can be the implication of this option? Anybody? What can be the implication of this option? I want to reduce my cost. My manager says, ma'am, let's take the material from a supplier who gives me cheaper. Anyone? Come on.
Professor, can you repeat, please, the question?
What will be the implication if I am using a less expensive supplier of raw material?
Variable cost will decrease.
Sorry?
Variable cost.
Variable cost will decrease. Yes, very right. But you may be compromising at the quality. Isn't it? You are finding a cheaper supplier, but you may be, compromising at the quality of the raw material. Got it? Reduce the amount of labor used. Then maybe more wastage will happen. More wastage will happen. The labor which is, the low wage employees which are there, they may not be very responsible. So if we are looking at one aspect, there may be other aspect also. So don't forget, as a manager, don't look into just one side of the picture, look into the other side of the picture also. That is what we need to say here. Okay, got it? If you are looking for a supplier which is going to give you cheaper, but you must see that your quality should not be compromised. Okay, right? See, let's see here what the next slide tell us. See here, considering the qualitative factors, what if a less expensive supplier is less reliable or provides inferior quality material? What if using the inexperienced worker cause more defective products? What if reducing the labor causes more machine costs, more, variable than the variable cost, more fixed cost is involved? So all these factors should also be considered when we are considering all these options to reduce the cost. Okay, it should not happen that you are reducing cost here, but you are increasing cost here. Okay, so that has to be taken care side by side. Okay, chaliye. So now let us take an example that they have decided to reduce the labor cost. They have decided to reduce the labor cost. So they have decided here. So let's try to reduce the labor cost. So now Happy Days decide to decrease variable cost by reducing direct labor cost by 10% through outsourcing. So now they have outsourced the labor. They are not keeping the laborers on roll. So they have outsourced the labor. This has helped them to reduce the labor cost by 10%. Example is clear, right? So we are reducing the labor cost by 10% by, okay, let's see now what happens here. We are selling 1,000 units, like 8,000 units we were selling, right? So what will be the cost of 8,000 units now? What will be the cost now? 10% reduction in the variable cost. In 72,000, 10% variable cost will reduce, 7,200 cost will reduce. So your variable cost will be 64,800. From 72,000, it will come down to 64,800. I hope it's clear, everybody, right? So your contribution margin will increase 35,200, and see your net income will, fixed cost will remain fixed, and your net income will increase to 15,200. I hope it's clear. So we have the decision to reduce the labor cost by 10% has helped you to increase the profit by 7,200. Okay, so this is how it has impacted. Let's check it further.
Professor,
Yeah.
please can you explain this example and the calculation?
Yeah.
This example. Yes.
Right. Yeah, I'll do that. Let's once again come to the example. Let's come to the original. Okay. This was your original picture, right? This was the company's original thing. 8,000 units they are selling at 1 lakh selling price, right? And variable cost was 72,000. So contribution margin was 28,000. Fixed cost is 20,000. This is your original sheet. Now the company has decided to reduce the variable cost by 10% by reducing the labor cost. Okay. So now you can say we are reducing the labor cost. What is the 10% of 72,000? 10% of 72,000 is how much? 7,200. 72,000. The cost will be reduced by 7,200, right? So the variable cost will be 72,000 minus 7,200. So variable cost is 64,800 now. Mohammed, I hope it's clear now. Right. So sales minus variable cost. What is your new contribution margin? The new contribution margin, you have reduced the variable cost, your contribution margin will increase. Fixed cost will remain same. Fixed cost will remain same. So your net increase in variable, increase in contribution margin is increase in profit. Increase in contribution margin is increase in profit, because fixed cost will remain same. Fixed cost will remain fixed, right? So see here, the cost has reduced by 7,200. The profit has increased by 7,200. Okay, got it? Right. Okay. So let's see another second option. The second option is you increase the sale incentives. You increase the sales by giving more sale incentives. Now here, what are the marketing manager estimated? If Happy Days raises the sale commission by 10%, you give 10% commission extra. Commission by 10% on the sales above the present level, sale will increase by rupees 42,000 or 3,200 games. Have you understood the second option? Now we are trying to increase the sales by giving 10% extra commission. 10% commission on sales. Okay. So let's see how the picture will be. So when you give extra 10% commission to your salesman, they are able to sell more games. How many more games? 3,200 more games they are able to sell. Earlier, they were selling 8,000 games. Now they are selling 11,200 games. See that picture here. See here now. Earlier, they were selling 8,000 games. Now they are selling how many games? 11,200 games, right? So how much will be the sale? With 11,200 into 12.5, the sales value will increase to 1,40,000, right? And what will be the cost? 11,200 games into 9, which is the original variable cost. And for the additional sales of 40,000, you will have 10% that extra commission, 4,000. So it will come to 1,04,000. I hope you have understood this. Not easy. Not easy. Let me tell you, it's not easy. Little you need to.
Can we return to the details of the case?
Yeah.
Yes.
Yeah.
The marketing manager estimates that Happy Days raised the sale commission by 10% on all sales above the present level. Sales will increase by 40,000 or.
Okay, now I'll explain here first before going to the answer slide. Let me tell here only. Earlier, they were selling 8,000 games, right? Now with this incentive, they are selling 3,200 more games. So how much is the total sales now? 11,200 games they are selling, right? And the selling price is 12.5. This is what we took earlier.
Yes.
The selling price is 12.5. So 11,200 into 12.5. This gives you the selling prices 1,40,000. Okay. This is your sales now, the new sales. Okay.
Yes.
What will be the new variable cost? What will be the new variable cost? So now we are selling 11,200 games. And what was the earlier variable cost? 9 rupees per unit. The earlier variable cost was 9 rupees per unit. If you can, if you want to go back, I can go back and show you.
Yes, 9.
Yeah, CK.
9.
The variable cost was 9 rupees per unit. Okay, right. But this time, what you are doing, along with this variable cost, your sales, but you have to give 10% as sales commission. This additional 40,000 sale, what has come additional, right? On this 40,000, you have to pay a 10% commission into 10%. Okay, got it now. So what will be my variable cost? My variable cost will be 11,200 into 9, 11,200 into 9, which is 1,08,000 plus 10% of 40,000, 4,000. So total variable cost will be 1,04,800. I hope everybody is clear now, right? More games we are making at a cost of 9 rupees is the original variable cost, but now on additional sales of 40,000, we have to give a commission of 10%, which is a variable cost, right? So 40,000 into 10%, 4,000. So this will be your variable cost. Now I think you will be able to understand this slide. Clear here? The new sales is 1,04,000. New variable cost is 1,04,800. 1,40,000 is the sales, 1,04,800 variable cost, and your new contribution margin is 35,200. Fixed cost remains fixed, and you earn a profit of 15,200. Is it okay? So with this, again, you are getting an additional profit of 7,200. I hope it's clear now. Got it? Right? So this is how we play with the contribution margin, and this will how we will take the decisions. Now, third option. Third option, what was available to Happy Days? Improve the features. You know, you have more features in your game. Kids want to buy your game, as compared to the competitor. So you improve the features and spend more on advertising, right? So what happens now, what the company has done? So they have new game feature. They have added the features to their game. By adding the feature, the variable cost has increased by 25 paisa, 25.25. 0.25. What was the variable cost earlier? Anybody? Variable cost was 9. Original variable cost was 9. But now variable cost will be 9.25. Because you have added one more feature in your game, your variable cost will increase by 0.25. So your new variable cost will be 9.25. Got it? And second, one is adding new features and second is advertisement. So they are saying additional advertisement of rupees 5,000. So 5,000 will be additional advertising cost, causing 40% increase in sale. So means again your sale will increase by 3,200 units. Clear? And with these features, adding new features, adding new advertisement, you can increase your selling price. Now your selling price is 13.25. Are you all getting? Right? Let me put a slide here to make you understand. Right? Selling price earlier was 9 rupees. But now what is the new selling price? The new selling price is, sorry, not 9 rupees. That was a variable cost. I'm sorry. The selling price earlier was 12.5. And now what is the new selling price? The new selling price is 13.25. The new selling price is 13.25. Right? Earlier, the variable cost was how much? 9. And what is the new variable cost now? Anybody?
9.25.
9.25. Very good. 9.25. Got it? So, contribution. Contribution. Sorry. I'll just write here. See, how much was the contribution earlier per unit? The contribution was 3.5. Selling price minus variable cost is your contribution. And what is the new contribution? Anyone? New contribution? 4 rupees per unit. Got it? Got it? See the change? See the change? Right. And the next part here is, see, this 5,000 is increase in the fixed cost. Advertisement cost is a fixed cost. So with this option, there is a change in fixed cost also. Now let us see the slide which is here. See here now. What is happening in option 3? So now you have a sales of 11,200 units with a new selling price of 13.25. 11,200 units with a new variable cost of 9.25. And then you have a contribution of 4 rupees per unit, 11,200 into 4. This is your new contribution. But see here what has happened. Your fixed cost is now 25,000. Earlier, the fixed cost was 20,000, but you have spent 5,000 more on your advertisement. So this has increased your fixed cost and your net income increases to 19,900. I hope now everybody is clear, understood how we are playing with this. The main important thing is to understand contribution. Very important. Contribution, because this is your deciding factor. This is the main factor which will help you to decide. Okay. So here your net income increases to 19,800. See here. Now we are comparing the 3 options. In the first option, what did we do in the first option? Anybody? What did we do in the first option? We reduce the labor cost. That was our first option. Second option, we increase the sale by giving the sale incentive. And third option, we improve the features in the product and advertisement, and then we increase the profit. These are the three options we have discussed in this case study. So you can see here, so this is a comparison. In the first option, the net income increases by 7,200. In the second option, the net income increases by 7,200. In the third option, the net income increases by 11,800. But you are a manager, you are a CEO. Don't forget the qualitative factors. This is the quantity, or you can see the profit here. But CEO must assess the inherent risk in each option, including the sensitivity of a decision in the key assumptions. You know, you are trying to here in the option one, you're trying to change the supplier. You've changed the supplier, but are you sure that he will give you continuous supply of material? That is a factor to be considered, right? Right now, we are considering whether with that option, you may increase profit, but it may lead to stoppage of production. He may not be able to give you the continuous supply of material. So that will result into losses again, like that. So with every option, you need to check what are the risks associated with all the options, and then you can take the different decisions regarding how the change in cost will impact the change in profit. Any doubt here till now? Anybody? Any doubt here? Anything you want me to talk again, or any option, anything not clear? Okay. Shall we move further? Good. Okay. The next is break-even analysis. Break-even analysis, very important for decision making. What is break-even analysis? So what is break-even? Break-even is the level of sales at which contribution margin just covers the fixed cost. Contribution margin is equal to the fixed cost and the net income is zero. The net income is zero. That level of sale is called the break-even sales. The contribution margin is equal to fixed cost. We will not be able to earn anything. It is called no profit, no loss situation. No profit, no loss. The level at which the company will break even is called no profit, no loss, right? So that is called break even. So break even, we use this formula for calculation: fixed cost divided by contribution margin per unit. If you want to calculate break-even point in units, if you want to calculate break-even point in the volume of sales, then fixed cost divided by contribution margin ratio. Just now in the same example, what we did, you can see here, the contribution margin per unit. The fixed cost is 20,000, contribution margin per unit was 3.5. It means once a company sells 5,714 units, company will break even. The company will reach no profit, no loss. After that, every additional unit sold will give you profit because you have recovered your fixed cost here. Your fixed cost is recovered by selling this much units. Any unit sold more than this level will give the profit to the company. I hope this point is clear, everybody, right? Anything, any sales more than break-even sales will earn you profit. You can see here, if we want to calculate in rupees or in the volume, fixed cost 20,000 divided by contribution margin ratio 28%. So it means when you are selling the sale prices this much, you will be having no profit, no loss. Any sale more than this will start earning you profit. So that is called break-even point. And if you remember, we did Erin and Teresa. Erin had higher fixed cost, Teresa has lower fixed cost. So what will be the thing here? Higher fixed cost means you will need more sales to start earning profit. Lower fixed cost means you will start earning profit earlier. So that is how this break-even point plays the game here. Clear? Break-even point? Okay. Solve this. Everybody will solve. Let me see who will put an answer to this. Small exercise, very, very small and easy exercise. Indolysis Limited sells logs for an average of 900 per log. The variable selling price is 900. Variable cost is 300. Logging operation requires substantial investment in equipment. So their fixed cost is 54 lakhs. Company president is considering an investment in a new piece of equipment that will increase monthly fixed cost by 6 lakhs. How many additional logs should be sold to break even? I hope you have noted this formula of break-even point. Break-even point is equal to fixed cost divided by contribution margin per unit. If you have not noted, note this. Now, this is a very, very simple. It should not take more than 10 seconds. Okay, just give it a try. If anybody else other than Mohammed can answer, I will be more happy. Because okay, anyone can tell me what is the fixed cost? What is the fixed cost now? Just tell me the fixed cost. Anyone? So the fixed cost here, it is 54 lakhs, but the company is planning to spend 6 lakhs more. So what will be the fixed cost now?
16.
60, yeah. The fixed cost will be 60 lakhs, right? So the fixed cost will be 60 lakhs. And you just wrote the formula to find out the break even, fixed cost divided by contribution per unit. Okay, now what is contribution per unit? Anybody else if can answer? What is contribution per unit? In this, very good. The contribution is 600. 900 minus 300. Selling price minus variable cost. So it is 600. So how many units will be required to break even? How many units will be required to break even? 10,000 logs. 10,000 logs that will be required to break even. They must sell 10,000 logs. Then only they will be able to break even. Selling more than 10,000 logs will fetch them profit. Okay. Selling more than 10,000 logs will only fetch them profit. Clear? Right? Shall we move further? Okay. So this was a calculation for the same. Okay. One more exercise. One more exercise. Let me see. Very interesting. Callan Seafood Restaurant is a family-owned business started by Mark Callan over 10 years ago. Callan is only open Thursdays through Saturday and only serves dinner. In the last several months, Mark has seen a drop-off in business. Just last month, the restaurant broke even. The Mark Mark looked over the records and saw the restaurant served 1,000 meals. 1,000 meals. Variable cost is 500 per meal, and paid other bills which were amounting to 12,50,000. He looked over the bills and realized that they are all fixed cost. Currently, the restaurant is break even at 1,000 meals. How much would be the selling price for the meal? How much should be the selling price for the meal? So, how much is fixed cost? $12,50,000 is the fixed cost. Everybody is with me? 12,50,000 is the fixed cost. Right. Fixed cost divided by, we need to find out how much is the variable cost or contribution margin. But we don't know how much is the selling price. So selling price minus variable cost is 5. Fixed cost divided by contribution per unit. Now we have been asked, what is the selling price? Selling price is not given. At what rate he is selling? His variable cost is for the meal is 500. Selling price minus variable cost. So this is equal to, the break even is given as 1,000 meals. The break even is given as 1,000 meals. 12,50,000 divided by selling price minus 500 is equal to 1,000. Can anybody calculate selling price now? Try it. See here. Variable cost, sorry, fixed cost plus variable cost is contribution. Fixed cost plus variable cost. Fixed cost is 12,50,000. Variable cost is how much? 500 per meal. And how many meals you are sending? You are selling 1,000 meals, right? So fixed cost plus variable cost is your contribution. So total contribution is 17,50,000 divided by 1,000 meals. So your selling price is coming at 1,750. Is this calculation clear?
No.
This is fixed cost. And this is variable cost. Fixed cost given in the question. Variable cost 500 per meal. How many meals he is sending? He is selling 1,000 meals right now. So fixed cost plus variable cost. This is your contribution. And because this is the level where you are contribution. This contribution, this is a level which is a break even, means no profit, no loss. Contribution is equal to the fixed cost, right? So here it is given. So contribution plus variable cost is equal to the this thing contribution. So contribution, total contribution divided by the number of units sold. This is your selling price. Okay. Once again, you can check here.
Professor, can we return to the calculation of in the slide of 53? Yes, fixed contribution. And FC divided by sales price minus
fixed cost divided by contribution per unit. Selling price minus variable cost per unit should be equal to the number of units. Okay.
Here sales price is.
Okay, I'll show. See here. If we solve this equation further, 12,50,000. If you cross multiply, 1,000 will come this side, and selling price minus 500 will go up. Okay, so it is how much? Okay, got it?
Got it, yes.
12,050 is equal to selling price minus 500. So from here, selling price is equal to 1250 plus
Yes.
both ways you can do it, right? That's why I've explained you both ways. This way also. Got it? So what does this tell us? So when there is a break even, the contribution is equal to the fixed cost. Means the same is the whatever is the contribution, that is covers the fixed cost. So that is why it will be the same. Okay. Okay. So now, how we are going to use this contribution theory to take different decisions in business? This is another interesting thing. Now, if we have a special order, sometimes a company receives special order. Maybe like, I am in India, but I am getting a special order from, maybe Bangladesh, or maybe from London, I get a special order. Now I need to decide whether I should take that order or not. Right? So that is called a special order, means not from your original market. The special order is from some other market where I'm not selling. That order is called a special order. Deciding whether to accept a special order is a short-run decision. So now what are the things what we should consider? What sale price is appropriate for one-time customer? He's going to be my one-time customer only, right? Second, we can accept a special order only if I have an excess capacity. If I don't have the excess capacity, how can I accept a special order? Right? If my production capacity is 10,000 and I am making 8,000 units, how much excess capacity I have? I have capacity of 2,000 left. So I can accept an order only if I have a special capacity, if I have excess capacity. If I have got a capacity of making 10,000 units and I'm already making 10,000 units and I get a special order, how can I take that order? Because already I am making 10,000 units. If I accept a special order, I may be compromising at my original customers, right? So that is why we need to check whether the company has an excess capacity or not to produce the goods for that special order. And third is, can it produce additional units with the existing resources? Do I need to spend more fixed cost or other resources to produce the goods of special order, or within the same resources I can produce? If all these three are there, then only you will take a decision whether to accept or reject a special. So these are the three conditions which are required. If any of the three conditions are not met, you cannot go for the special orders. Clear? So first thing is whether my sales is for just one-time customer. Number two, whether do I have an excess capacity to produce for that special order? And the third thing is whether that additional units can be made within my existing resources. So all these factors I shall be considering before I will accept or reject a special order. Now let's see. If I don't have excess capacity, special orders are almost never accepted if the business does not have excess capacity. If I don't have capacity, I am able to just meet the requirement of my current customers. I cannot have a special order. But if I have excess capacity, then maybe a special order is profitable, but you also must consider the qualitative factors. What are the other factors that will influence? Right. Okay, now we understand this by taking one very interesting example. Everybody can pay attention. Very interesting example. This is given, a case study is there for Sunset Airlines. Imagine that a Sunset Airline has been asked by a large corporation to provide 150 seats to two executives attending a conference. I hope you got the case study. What is the option? Now this one company is asking the airlines to give 150 seats to their executives who are going to attend a conference. Now what is the other picture? The company is offering to pay $125 per ticket. Whereas the normal fare is how much? $275. Yes, Mohammed, will you accept the order? Normal fare you are charging is $275. The company is offering you $125.
Is the offer of the company this?
The company who wants there to for the airlines to take 150 employees. 150 employees for a conference, they are offering only 125 per passenger, though we are charging 275 per passenger. Okay, so now let's analyze the other part of the thing also. The ticket is only good for 1 day only for any of the 5 flights. Now this Sunset takes 5 flights in a day from that place to the place of the conference. So any one flight the passengers can take. The aircraft carries 180 passengers per flight. So 180 into 5, 900 passengers per day they carry. What is the capacity? What is the capacity of the aircraft? 180 passengers per flight, and 5 flights are there. So for the 5 flights, the total passengers the airlines can carry is 900 passengers per day. Currently, the air company, the airlines, they are carrying 700 passengers per day. What does this mean? What does this mean? They have a capacity of 900, but they are carrying only 700. Anyone? What does this mean?
There is a lack of 200.
So there is an excess capacity. They have capacity. They can carry more passengers, right? So they have 200 extra. They have excess capacity to carry 200 more passengers, right? So Sunset has excess capacity. Now the point is, now first thing is, okay, you are there, you are the manager, you say, okay, let's be, as such it is going waste. You are spending on everything. The crew members are there, the plane is flying, less 200 passengers. Why not? Why not? Let's take them at 125, isn't it? Right? So they have excess capacity, but let us see whether we should accept the order or not accept. Let's analyze it further. Now, special order. Now, what are the options? Sell the special order ticket at 125. Sell only at 275, whatever is your market price. Sell the special order ticket at another price. Now, these are the options a manager will have. Either you accept the company's offer at 125, or you say, no, my airlines, we will give you only at 275, which I am giving to my other customer. Maybe I lose my other customers. If I give you cheaper rate, my other customers will also ask me to give them cheaper rate. Isn't it? Right? You may lose your regular customers if you are giving cheaper to one corporation, then the other corporation say that please, you will give us also, right? So you may lose your customers. So you say, no, I will stick to my 275 only. Or you may calculate another price and give a counter offer to the company, right? So these are the different options which are available to the manager of the Sunset Airlines. So let's understand this now. So what is the objective? End of the day, the basic objective of every business is to maximize the income, right? So that it should not be impacting our long run decision. So let's see what are the cost details of the company. What are the cost details, right? So we have already understood that they are selling the ticket at £275, $275, right? So 275 they are selling, and how much it is costing to them? The cost of meals, the cost of fuel, the cost of cabin crew, 4 flight attendants are there, the cost of flight crew, depreciation of the aircraft and aircraft maintenance. All these are the charges per passenger. 180 passengers they are carrying per day in one craft. Okay. So what will be the cost per flight? 6.5 into 180. So right? So this is per round trip. Everybody? Per trip. Okay, so I think we have not much time, so let me not go into much detail. I will just tell here you this thing that out of all these costs, only passenger meal is the variable cost. Only passenger meal is the variable cost, which will vary if we have more or less passengers. All other costs will be fixed, whether we are carrying like full capacity passenger or we are carrying half capacity passenger. I hope this is clear, right? So let's not go into the whole detail. Let me just quickly wrap up because we have the less time left, right? So all other cost is the fixed cost, only the meal cost is the variable cost. Now see here, using the full cost analysis, it looks like Sunrise will lose. Your total cost is coming at 137.61. This is the total cost. And the offer price is 125. So if you accept this offer, directly you are losing 12.61. Directly you are losing because it is costing you 125. But the point is, what is the in the first part of the lecture, I told you there are certain relevant cost and irrelevant costs. Relevant cost is which impacts my decision. So here we need to understand what is the relevant cost for my decision. The relevant cost here is the fixed cost. See here, almost all the cost is fixed. All the cost is fixed. Only what is variable? 6.5, the food and drinks cost is the variable cost here. Okay. So now what happens? So if the company, right? So you are charging 6.5 is your variable cost. And 275 was your normal fare. So if you lose this opportunity, what will be your opportunity cost? I'm sorry, excuse me. See here, opportunity cost. If we don't accept this order, then probably we are losing this 268 rupees because we are not selling anything to them. But here we are going to get 6.5 is the only cost what will be there. So the special order ticket is 125. It will cost you only 6.5. So the profit you will make is 118.5 for each passenger additional. Are you getting me? See here, we are spending our cost is coming as 137.61. Out of this, only 6.5 is variable, rest all is fixed. We will be spending this anyhow, maybe half capacity passenger, maybe full capacity passenger. Only what will vary? What will increase? 6.5, the meal cost of the passenger will increase, right? So in case I get the offer, I take the offer, how much will be the profit to me? 125 is the ticket I am selling. Out of that 125, I will have to spend only 6.5 on meal. The profit will be 118.5. Is it okay? Because I have the excess capacity, I will get a profit of 118. I'm getting the ticket for 125. Clear? I hope this example is clear, everybody, right? Only the variable cost matters. The marginal cost matters. The fixed cost will remain fixed, whether you are taking, 180 full passengers or you're taking half passengers. Okay. Since we are short of time, I'll not go into the other costs what are given in this same illustration question. So let's go to the other example. Okay. Let me skip. Divya, how much time do we have? What time do we wrap up?
We are already behind the time. We ideally wrap up at 4, but if you want to wind up and then.
Okay, just give me 5 minutes extra. Let me give them 1-2 more decisions to understand. Just, I hope it's okay with everyone. Can I take like 5-10 minutes extra, everybody? If you can say.
Okay, Professor.
Okay, just give me 10 minutes, right? Okay. So another type of decision can be make or buy decision. Whether you want to make a product or you want to buy a product. If you're making something and you have a one component, you make every component of your product, but you have a choice that whether you should make or buy a component. So let's look here. This one example here. So this company, they make the golf kits, and one of the golf kit component is putter, with which they put the golf ball into the kit, right? So when they are making the putter, it is costing them 26.5. It is costing them 26.5, and in the market they are able to buy at 25. Are you getting? Make or buy. I am making it, it is costing me 26.5. But if I buy from the market, it is available at 25. Whether you will accept or reject, will you make or buy? The making cost is 26.5 and the buying cost is 25. Anybody? Simple.
You will reject?
Sorry?
You will reject, Professor.
You will reject. Why you will reject?
The price in the market less than the production price. The cost is more than the price.
No. Cost of buying. We are making. When I am making in-house, it is costing me 26.5.
Yeah.
I'm buying from the market, it is available at 25. The making cost is 26.5 and the buying cost is 25. Now tell me, if I'm making it in-house, it is costing me 26.5. If I buy from market, it is costing me 25. Would you like to make or would you like to buy?
It's preferable to buy.
It is preferable to buy, but very interesting point. My last take for today. You are buying. Now see here the analysis. The analysis is 26 out of 26.5, 9.5 is my fixed cost. 9.5 is my fixed cost. Even if I don't make, I have to spend 9.5. Right. So what will be my buying cost? 25 plus 9.5. My total cost will be 34.5 if I buy from the market. Did you get this? Got it? I am making it 26.5. It is available in the market at 25. So as Mohammed said, it is better to buy. Why are you spending 26? Yeah, but I am telling you a different story. Even if you are not making, your fixed cost remains fixed, even if zero production. Your fixed cost remains fixed. You are not producing, still you are spending this 9.5. See the component here. Material, labor, variable cost, my fixed cost per unit is 9.5. I will have to spend this. Just now I told you, even if zero production, fixed cost remains fixed. Right. So here, so 25 rupees I will spend on buying and fixed cost of 9.5. Total, it will cost me 34.5. Right? The buying cost plus my fixed cost. So here I will be losing 8 rupees, $8. Okay. So this is very interesting. So you need to be very careful about your fixed cost. Every organization, when they are playing with cost analysis, you must take care of the variable cost as well as the fixed cost. Then only you will be able to make the different decisions. So the different type of decisions like make or buy decisions are there. I have got different games were there, different other examples were there. Then you can also decide upon whether to make a product or drop a product, you are making 3-4 products, you can compare like whether we should make or drop a product. So all that things were there, but since there is a lack of time and I've gone a little slow also so that all of you can understand whatever I'm delivering. So I hope something it's a takeaway and you must have understood some part of cost analysis, what we have discussed in today's session. Any questions, anybody?
Thank you, Professor. It's a very interesting topic. Really, really.
Yeah, thank you so much. Thank you. I hope all others have also enjoyed and learned something from the session, and probably see you again sometime, although I'm not taking any other session in this particular workshop, but I hope we'll meet soon in some other workshop. And thank you all of you for joining this workshop, and I hope you all are having a good time. And tomorrow and day after, you will be learning more about the financial analysis and how the financial statements are being compared and all that things. Thank you so much, everybody.
Thank you, Dr. Punita. Thank you for, linking everything for them. It makes very easy to connect all the dots. Thank you, participants. Thank you for today. I am sharing the feedback link with you. Do fill it and we connect tomorrow at 11. If anything, just feel free to connect or contact me or anyone. I'll also share faculty IDs so you can connect with them for any doubts. Feel free.
I'll write my mail ID here also.
Sure. Thank you once again, everyone, Dr. Punita and participants. Have a nice day.
Okay. Thank you. Bye-bye, everybody.
Thank you, Professor. Thank you, Divya.
Yeah. Thank you. Bye-bye. Feel free to contact me anytime. My mail ID is here. Anything, any doubt, please feel free. Right. Thank you so much. Bye.